I'm great, thank you. How are you?
Although I hear that not everything going as planned in the footy universe for you.
Yes, I've received a lot of abuse from the gallery. I think a few people here might know I'm a big Chelsea fan, which we lost last night. So I've been receiving a lot of abuse from the gallery, who are mostly Arsenal and Tottenham fans. So.
They are mostly Arsenal fans
So
here.
that starts the morning already. So.
Oh, let us know who your team is. Morning, Derek. Morning, Andrew McKilvey. Andrew there out of the gates talking about Ofgem publishing its proposals for the next electricity transmission price control period. SSE and National Grid are working out what it means for them, for us all, higher bills. Yes, that's right. I say, as the person has just recently drilled through my lovely masonry to put an EV charger there.
How's the old Polestar going?
I still miss the sound of the engine. Don't judge me, people. Don't judge me.
I get what you're saying. You know, when you're roaring down a road, you kind of want a bit of oomph, right?
Exactly. But it's got a lot of oomph, actually. The torque is unbelievable. But I also get that the modern generation and the generations coming through, if you've never known what a combustion engine sounds like, then you're not likely to miss it. However, last night I did become fond because the Polestar switched on the warm, cushy seats and adjusted my chair and also warmed up my steering wheel and put my favorite radio station on before I started the car. That's
a hell of a leap in technology, I guess.
That is a leap, yes. Morning. Maturin Snowflake, talking about Snowflake as well. Yes, I have that on my radar. And Jessie14, good morning, Friar Tuck as well. Let's take a look at the weather, shall we? Here we are. It's quite...
Well, it started to brighten up at least.
Yes.
I left home and it was pitch black this morning. See the stars still.
At least it wasn't frosty like a few weeks ago.
Pleasantly warm and also no rain. So I think that's the most important things when you're living here is to avoid the rain and not be frozen. So at the moment we're having a fairly pleasant December.
Yeah, we are. And also I have to say the other thing to remember as well is that whilst our weather is changeable, at least the market seems to be coming down a bit, right? Speaking of that, let's take us through the coming up because we have a huge lineup for you today. We got Ron, of course, with me, and through to the opening bell. And then we have...
Man versus Machine, but guess the chart is coming up slightly before that at 8:10. And then it's Man versus Machine with myself and Martin Harris.
Yes. And then we've got Expert Edge with myself and our brand new guest, Thiru Nagapan, CEO of Master the Markets. If you like consistency, if you like probability, if you like Ange telling you each day, stack the odds in your favor, then you need to watch this show with Thiru because we go through how to use a different type of software to actually crunch out numbers so that you can really see the probability of your trades no matter what time frame. And then at 9 we have the Art of Investing, episode 21. Right, let's head over to Overnight Action. Hey, welcome back to Overnight Action. And what were you up to yesterday as the indices all close higher? This Christmas cut expectations.
Yes.
I thought it was all baked in already.
Well, it's getting even more baked in. I think the probability is increasing from, I think it was around 60, and now it's around 80% the last time I checked Fed futures. So, yeah, I think, look, if you've got a portfolio which is largely geared towards the US stocks, which I think a lot of UK investors do tend to have an overweight, I think some of the classic value investment houses will be more skewed towards UK equities. But I think a lot of retail investors, particularly the younger generation, got a large chunk of US equities. So they will be praying for that rate cut and praying for that rate cut trajectory to come to fruition. So equities continue to march on and the US economy can get that abundance of liquidity to push equities forward.
And the way I'm looking at it, this is my humble opinion, with JP heading out the exit, and Trump has already said he's going to name, I think his office as has actually put down a time frame. I think in January, is that right? Or early next year? Trader friends, if you know, please clarify, let me know, because I think I read January or early next year. You know, that'll just put more pressure, downward pressure on rates, right?
For sure, yeah.
Got control. He's going to want to make it so that everything's cheaper, or most things are cheaper.
Well, if you look at his business throughout the years has always been built on leverage. I mean, through his property development and things such as that. So I think he's a big proponent of liquidity, of low interest, and yeah, no doubt that he's going to be pursuing those sort of policies if he can get the central bank to do those sort of things.
Thank you for our talk. Early next year, that is right. And let's have a look at the markets. Just a quick overview before we look at how Asia settled overnight. You see quite a lot of blue, or rather we say green, numbers there. Looks like we're in that Goldilocks sweet spot, right? So volatility at a point where it's not exactly, so low that markets are just completely crazy, but it's enough for it to be risk on.
Are you expecting a big Santa rally?
Well, some argue, I was speaking to analysts yesterday that I've known for a very long time in the US on Wall Street, because as you know, I've worked there in my previous iteration. Some of them think that it's already started. So let's have a look at Asia. Here we are. Read out the numbers for us.
Japan 225 is up 2 3/10%. Hong Kong HS50 up 0.5%. China A50 up 0.4%, and the Nifty 50 up around 4 basis points.
Let's have a look at this as well, because have a look at that. Because, we take a look at the ISM services PMI as well. The red line is your headline, the green is employment, and the yellow new orders, and the blue their prices paid. I mean, essentially, this is, all indicating that we're seeing, inflation tame as well.
Yeah, I think there's two arguments I'd say against that though, Ange. I mean, you've begun to see a little bit of inflation come to fruition in goods inflation in America. Throughout the end of Q3 in particular, you start to see that being baked in because of the tariffs. I think it's still a case of, with inflation, a case of, will the trade war continue next year? Are tariffs going to affect things significantly next year? And I think it's very much a wait and see with inflation, which I think is why you're seeing central banks, hold back slightly just because they don't want to be. I think people always talk about, the double dip inflation, cutting rates, it then comes back and rears its head again. I think we had that 70s or 80s, a bit before my time. So, but yeah, I mean, we've had those sort of experiences before, which central bankers want to avoid. So yeah, I think there's going to be a lot of that going into the new year because we are out of the woods, but we can be dragged back in anytime.
We can be dragged back in, but can we be dragged back in, or is the Fed and the new Fed chair going to have more ammunition to actually lower rates? Because this is what I want to show you. This is the next chart I'm putting up for you, and I'm sure Gallery is going to say FN F11 before I even think it. So because we've been waiting on all this data, the private payrolls have become more important than usual.
Yeah, absolutely.
Right, and here you can see that the ADP National Employment Report, friends, showed that U.S. private payrolls unexpectedly fell in November. Now, I wonder if all this is going to also point to lower rates. And, markets obviously will be happy. Stock markets will be happy.
Oh, yeah, absolutely. They love liquidity. They love anything which can get the economy moving quickly.
And so this will just give the Fed more ammo, right? Just to lay off that hawkish tone.
Definitely. If they see any cracks, then they've got to obviously counterbalance it with inflation, because there is that dual mandate of, well, of the inflation level, but also the economy. And we saw in COVID era that they sort of jumped to the rescue with an abundance of liquidity through quantitative easing and through getting rates to zero. So that was obviously, the potential for a depression in terms of the fall in employment that we saw in that very short, sharp period. But if we see cracks, then I would expect them to use many tools at their disposal now, because I think prior to COVID years and the 2021, 2022, where we saw rates come back to normal and normalize, we saw, a lot of discussions, particularly when I was at university, around the times of, well, what can central banks do when their rates are at 50 bips in terms of if they need to put liquidity into the system? Well, now they've got it much more simpler, because they can cut rates at 400 bips to 350 quite easily, or 375.
Morning, Neil. Morning, Funky Gibbon. Morning, Julian, as well. Where were you? Were you a bit late because you were making your coffee? So just getting everyone across what's happened, and it looks like it's still looking risk on or slanted towards that. We had Microsoft, one of the ones yesterday. That was one of the ones I was watching as I was trading silver, and Microsoft fell. And this is as much as 3% actually. This is after the tech giant cut its AI software sales quotas. Many sales staff there missed targets, so it was interesting. Marvell jumped though. We talked about this earlier. Marvell technology, one that many people here have positions in. This is after the chipmaker said it would buy Celestial AI in a deal worth $3.5 billion. And last but not least, we also talked with Julian Wheeler. Julian Wheeler, my guest that comes in from Shard. 2 days ago, if you're watching and listening carefully, we talked about Dominion, Old Dominion Freight Line, which was his call. If you were listening to us carefully, boom, you would have seen that big move, the Morobuzo there on the right-hand side, showing you the action on the 1 hour chart to show you that move. 2 days ago he was in. And there you have it. Right, let us know on the chat if you were in on Dominion, because according to Julian, it messaged all of you. This is, of course, freight. And they take all sorts of manner of things in trucks and things. The Dominion is just leaving the depot.
I had to think for a second, but that was good, yeah.
It made me smile yesterday. Right, let's have a look at some of the newspapers. Right, so I see you don't have your laptop there.
No,
but that is okay. What happened to your laptop today?
It just wouldn't turn on, but I think we can rescue it. I think I think the charger was a bit dodgy here, and it's out of juice. So charging outside, it's safe, hopefully.
It's in A&E.
It is.
Yeah.
It's on life support now, so.
So let's have a look there. This is the front page of the Financial Times there, talking about bond investors warning the US Treasury over picking Hassett as Fed chair. Yep, Friartuck, who checked on the date or the timeline for me. Yeah. Thank you very much.
And I think the bond investors are worried about, I think, cutting too quickly if there is lingering inflation. And that I guess it's always concerned with the US now in particular, which hasn't been in the limelight for a while, is the debt to GDP ratio, which you've seen rising term premium in the long end of the bond market. And I think this is just really further evidence of that, is that the investors are going to demand that higher term premium if they're concerned about government spending, but also excess liquidity, which, could be inflationary, I guess.
Yeah, what's also interesting is they're talking about, all these reports coming out showing that Trump has delayed and abruptly cancelled interviews with the finalists for the Fed chair, or just stimulated all this talk about whether this move to cancel interviews meant that Kevin Hassett is this favorite, and also likely to be in the very, very hawkish, right, camp favoring aggressive interest rate cuts.
Yeah.
There's also, of course, this other story about how Brendan Nelson became HSBC's stopgap chair. If the floor, the gallery would like to come off my chart, we'll see whether we can get the times up for you. And here we are. Producer Phil, you need to tell someone that they haven't put 50p in the meter for the times. Phil saying it's not his login. Here we are. So we've got the times there, and it's leading with Glencore axing 1,000 jobs, but plans to double copper production. I didn't make them write this, but this is music to Andrew's ears, because my this is not trading advice. My humble opinion is copper is due a moment, and it will happen in 2026.
Why is that so?
So first, we've got supply constraints, and the second, most importantly, everyone says, "Oh, Ange, you're such a metals fiend. We thought you were so into tech, but then now you turn into a commodities trader." What they don't realize, friends, is that this is very much still linked to my heartland, which is tech. What do you need to create data centers?
You need metals.
You do, a lot of it.
Yeah.
Which is why this year, many metals have been added to the US's critical mineral list, including silver, including copper. And you can talk till the cows come home about what chips are going to be used, whether they're going to be more efficient. You hear Bill Blaine talk all the time about it being, open, closed, right? All it means to me is you're just going to need more chips and more data centers. That's all it means. It doesn't matter which ones you buy, which ones are being used, which ones, winning the game. You just need more of this stuff, right? And so it's all linked to data centers. So I have silver, I have copper, I have gold, I have palladium for motherboards, people. Look it up, motherboards. A lot of tech enthusiasts, and I know that a lot of ex-IT experts here on this chat. So look it up and find out why all the commodities that Ange likes is linked to data centers. Good morning, Shilling, Warwickshire as well, and Julian Polestar. I did look it up. It still has got Chinese firepower. Go Gile. But it is very, very interesting that Gile have taken an extra and added to their stake and bought from Volvo. But I think Volvo still have about 10%. Please correct me if I am wrong. Senseo saying what matters is that you're following the lemmings by saying that all that matters is they need metals. Well, we'll see who is right. I'm not going for all metals. I'm going for specific metals.
Derived demand, as they say.
Derived demand. And also judging by the amount of tech that's building in my house.
You got one of those robots, humanoid robots now helping out.
The Neo.
Yeah.
I am hoping to trial one.
Wow.
I'm one of those people that never says never. I'd like to try it and then make a decision.
Yeah, I'm keen to see how that will help out with the chores and whatnot, Cook dinner and everything.
We've had a poll. Interestingly enough, most women would like it in the house. A lot of men that I have polled have said that if you have one in the house, you deserve to have it be the last thing you see before you die. But I think the divide there is also interesting because if you really boil it down, a lot of it's down to price. Right, so let's have a look. Thank you, Maturin. Thank you, Paul, telling me about the split on the 9th of December. That is also in my heads-up display. Right, Iran.
Question time.
Question time. Are you ready?
I am.
We're asking all guests and friends, please chime in as well, because this is an IG question to all guests and investors. What is your biggest investment lesson of 2025 and their implications for 2026?
Yeah, it's a good one. I mean, I think every year you learn something in the markets, and I think past 2 years we've seen US just fly and fly and fly, and people write off the UK for decades, and I think this is the first time where it seems to be, you know, we've still got around 30 days or so, 25 days of December left, but it seems to be the first year that the UK might outperform the US equity market. So my lesson is always, I mean, this is something I've known, but it's really now put into practice, and you can see this so evidently, same with emerging markets as well, is to be diversified and, you know, be cautious of valuations, because when things are cheap, providing that there isn't some sort of value trap in terms of the whole macro, especially when you're looking at things on an indices level, or there isn't structural concerns, is to be diversified for particularly for an investment portfolio, because having an overweight position in the UK this year or emerging markets would have been brilliant for your portfolio.
I mean, especially the UK, right? I mean, look at that. I'm just going to show you a very wide look.
17%.
Oh my goodness me.
I mean, if you got a screenshot of that and sent that to me last year, and asked,
no way.
But if you asked me what indices that was, I would say that's probably the S&P 500.
It's incredible.
Yeah.
Isn't it? I mean, what a tear. Who would have thought that we are now very close to that 10,000 mark?
If you go back further, you can just see how lackluster and miserable it's been for.
Oh yeah, look at that.
Yeah.
Good grief. Yeah, for those that have held on, well done you. I have always, and you know this, I've always said I would never track the FTSE, but look, I have been proven wrong.
There's some good investment trusts in the space, though. City of London is one in particular, which has grown its dividend for 59 years if you're an income seeker.
Oh, I am an income seeker. I like
one on your radar.
Have to look at this a bit later. Any of you chiming in as well, please let me know. We'll get that on the list too. Of course, we will ask Paul when he is on opening tomorrow. Thank you, Paul. This is maturing. Give me a bit of a break in the morning, although the lion just means that I wake up at 7 instead of 5:30 or even earlier. But here we are. Let's have a quick look at Snowflake, because someone talked about Snowflake. Look at that move. Let's give you the 1 hour chart so you can see the move there down.
Wow.
Oof, 6.7% there. The sales outlook falling well short of investor expectations. And that really sent its shares down as much as 8%, actually, around 8% in extended trading. This is, of course, the cloud data analytics firm. And speaking of gains in the year, take a look at this. This is another one that's been on a real tear. Let's have a look at the measuring tool there, which you can get on the IG platform just by going to that pencil there. It's very rough, this. It's not a snap to measure like the Bloomberg one, but it's good enough. And let's just take it from earlier this year all the way up to where we are right now. And roughly that is around 59%. I mean, crazy, right?
Yeah, been a blistering run for Snowflake.
Yeah. Right. Speaking of blistering run, we're going to go to a short break, and then we will be back to take you through the opening calls and count you down to the open.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris C.J. Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Here we go, here we go. You've got your bells ready.
I've got a
Iran.
choice.
Yeah, you've got a choice. Which ones are you taking? My goodness me.
I'm going to take the LSEG one, I think.
The LSEG one, very good. And as we count down, just getting you across some of the overnight headlines. Trump teasing Hassett as a potential next Fed chair. Worth keeping in mind that this came after several reports. These are reports, by the way, Mood Music saying that Trump has actually stopped some of the interview processes for now, which then caused all this chatter about Hassett as being the potential next chair. Also, what are you looking out for coming out of the opening bell today?
Well, I'm just always keen to see how indices do in terms of when there's always a bit of macro chatter going on in the background. So I'm just keen to see how they're reacting to just general, really, because we've seen a bit of a stabilization in the past few weeks when we had a bit of an AI slump. Things are now back to normal. And I kind of want to see if this rally is going to continue or there's going to be some more headwinds. So always interesting to see at the open where they're going to head.
Yeah.
I'm being.
Getting you across some of the moves from the brokers. Airbus cutting delivery targets after troubles with its most popular jet. We also have an eye on Bayer raised to overweight there at Morgan Stanley. Also, we've got Berkeley raised to buy at Jefferies. Ferrovial seeing some action there as well as Holcim. Hugo Boss. Do you have any Hugo Boss items in your extensive wardrobe?
Yes, I do. I've got a pair of Hugo Boss flip-flops.
No! Sliders?
No, I don't do sliders.
Not that I have anything against sliders.
No, I find them very uncomfortable.
I just think they're a health hazard. But
yes, you put slips through, you're going to trip over.
Says the person that is very, very retail unsavvy. Hugo Boss 2026 described as a year of realignment in strategy through 2028. Analysts suggest around 20% cuts to 2026 EBIT consensus. Right. 5 seconds to the bell. You ready, Ron? Are you ready at home, everyone? And here we go.
Market is
Let's
open.
have a quick look. It is early, and we're just seeing a lot of uncrossing taking place here, but we have some of the winners now. Take us through some of the winners first.
Go Anglo-American up 0.2%, 3i up 1.25%, Informa up 0.8%, Intercontinental up around 0.5%. Shell, which is one I own. Oh, that was up.
Rejigging it. Sorry.
That was up around 0.6%, if my memory serves me well. It's like a memory test now.
It is like a memory test. Sorry.
That's okay.
Right. So we got Persimmon up as well, and Rightmove also up there. Let's have a look at the losers list. It's moving really rapidly today. Take us through the losers.
Fresnillo down over 3%. Endeavour Mining also down 2.5%. Bats down 1%. Unilever, it's also had a bit of a bad year in general. Is down, 0.7%, and AstraZeneca, which continues its declines, down 0.4%.
Yeah. Taking a look elsewhere because there was a load of stuff that's just come through. We've got also moving on the French side of things. Let's go to France first. We've got some of the chip makers. ST Microelectronics up more than 3% there. Renault, some of the car makers coming back after a tough start to the week. Stellantis also now up 1%. BNP Paribas, the French banks, and Crédit Agricole as well, also coming back slightly now.
Yeah, quite a strong open for some of these companies in France across the channel.
You look more like a ka-ching kind of man.
You think so? You think so? That's very kind of you. I mean, yes, you know, there's some nice gear, but it's a bit expensive, some of it, for not very much. Some of it.
Yeah, well, you know, I'd rather have the shares, not the goods. Thales up slightly there after some of the defense stocks wilted slightly when Putin said there was no peace deal yet in sight.
As a BAE Systems shareholder, it's been a tough few weeks.
I did tell you. Were you not listening?
Well, I'm a very long-term investor, so that's my problem. I
did march over to you. I said after first quarter, half year, you need to.
I know.
Come out. As always, as Senseo says, do you like coffee or something, or are you like? Because Senseo is also a coffee brand. I know this.
Yeah, I'm a coffee fan.
You have to do lots of market research, your own market research.
The best coffee is Vietnamese coffee. If you ever had that, that is wonderful.
I'm really not into any coffee that comes out of some animals.
No, it's just normal coffee with condensed milk. It's wonderful.
Okay, I'll take your word for it. I'm a dark coffee. Let's have a look. Like my soul, black and bitter. Germany. Let's have a quick look at Germany before we look at commodities there. Right, we got Infineon, as mentioned earlier.
Adidas up 1.5%. Yeah, interesting to see that. And Mercedes up 2.3% today.
I know, they're all revving higher, aren't they?
Oh, I see what you did there. Revving.
Have to do that when one has the ability. Analysts, that's one of the joys of being an analyst. And also telling people to please do your own market research, because the other thing too is, even though you follow someone that you really rate, your duration, which is probably the most important thing for your investment, or your trade, could be different. So make sure you are aligned.
Time horizon is you know, particularly for the long-term investment, is imperative. Time horizon and asset allocation are the two most important things which determine what your return is.
Yeah. Are you a timing the market kind of man? Or are you timing the market?
Very much timing the markets. I mean, some of the stocks.
Oh, producer Phil, for our Discord and Trade Live with IG.
Some of the stocks I've owned for like over 6 years and haven't even touched them in my portfolio. So.
Are you more like a Charlie Munger, or are you more like a Rich McDonald? Timing the market, or time.
Sorry, Rich,
in
but
the market.
I'm not similar to him.
Hope
with that
you're
regard.
listening, Rich. Hanover Re also higher there. Reinsurers adding to early gains yesterday.
I'm waiting for more puns.
Crossing over to the losers list, not that many losers there. Let's have a look at that.
We've got Airbus is down. Mayday for Airbus down, down 0.5%. sorry, I had to throw one in there. Siemens is down 0.65%, and Henkel is down just 0.1%. So nothing too bad really coming out of Germany.
Nothing too bad coming out of Germany. Let's have a look at actually, before we have a look at commodities, let's have a quick look at SSE for Andrew McKelvey, and also Luke Moore has a position in SSE, and so does Rich Tea Biscuit, and it is down 1% there after Andrew McKelvey pointed out the Ofgem report. Let's also have a look at very quickly at Fraser's Group, because it was out with numbers, I think. Let's have a look there. Not much of a move there. Fraser's Group, first half revenue, £2.5 billion there. Moving across to commodities now. Ron, anything jump out at you? I will obviously, my eyes on the shiny stuff.
It's relatively flat today coming out of the commodity markets. I mean, nothing's really screaming to me. You've just got things up marginally or down marginally, not even a percentage point either way. So yeah, nothing really to write home about this morning.
Nothing to write home about.
There's nothing really which is the metals on the other hand. Your shiny stuff.
My shiny stuff
is down.
They are down. They are down. However, have a look. On the longer term,
as you said, the duration is very important.
It is very duration. And if you are looking to hold this into next year, then this is still very much an uptrend, yeah?
Yeah.
So for the shiny metals, just to quantify my duration here, I am looking into half of 2026, if not all of 2026.
I was speaking to a strategist about the metals, particularly gold for this one in particular. But if you see rate cuts come down, it's good for metals, because what happens is the real yield you get on the bonds is likely to fall. However, we've got a bit of a different dynamic with the large fiscal deficits and debt GDP ratio. But if you do get a sort of parallel shift downwards in the yield curve, which means yields across the board come down, there's now no longer an opportunity cost for holding metals, because obviously bonds pay that income, that yield, that coupon. But now it's a bullish move, I would say, for the metals.
I mean, forget Snowflake. Maturin, really sorry you got stopped out there. It's really painful when that happens. So that's why I really recommend, if you don't have time to look at your stops every single day, then have a trailing stop. I mean, never mind FTSE, silver up 102% so far this year.
Crazy.
Well done you if you managed to.
Maturin also likes condensed milk coffee. I mean, good company.
I mean, yeah. I love sweet things, but not with my coffee.
Really?
Yeah, I like it. How dare you, Phil? Phil said black and sludgy. And I like it dense and rich, like my man. Tin has been on a good run since April. Hope you guys got that joke. And let's have a look elsewhere in the commodities sphere as well. We have copper. And take a look at that. It has blown past easily as well. Blown past my area of interest that I drew for you there. And really marching up towards the next round figure there. 115 and then on to 116, but really silver is almost we're now starting to see a change in trend here.
Yes, we are.
If you trade gold and you trade silver, normally the old and tested saying is that gold leads, silver follows, right? So gold flies, silver flies a bit after that. If it falters, then silver falters a bit after that.
Yeah.
What we're now suddenly seeing, those of you that follow this closely for long enough, is that gold is following silver.
Yes, that is true.
Right? So silver pull back and then suddenly gold will follow. And my humble opinion, this is not trading advice. It's not trading advice. You can ask the Valdes. I've been marching over there. I have a feeling that because so much interest has been in gold and it's become so expensive, that interest is being mopped up by silver now, right? And we're even seeing that at the Baird & Co refinery that I visited earlier this week. They're seeing because gold is so expensive, interest is starting to filter into silver.
Yeah, absolutely.
Copper prices also hitting a record high on Wednesday. Don't forget, there is also a weaker dollar here at play, okay? And supply concerns, as I mentioned earlier, affecting copper. Two things in your tick box. I like whenever I have any trade in place. Some of you have seen my chessboard. I'm teaching my 10-year-old. She was 9, now she's 10. She's actually, Lou was like, she's running a book, isn't she? She's like, she always asks me about my tick boxes. You have tick boxes that tell you game over. It's no longer game on, game over. For me, when it comes to copper, I have a box that says supply eases. And the second one is dollar strengthens. So if those two boxes...
Then you're seeing a sort of economic decline, you're saying, from those things.
Well, it means I have to
drawback.
change my strategy, right?
Very, very macro heavy thinking there.
Also, super complex given the boxes are stuck to the side of my fridge. So you see it every day. You don't have it on some sheet that is, you've lost somewhere. It's on my actual fridge.
That's clever.
Maturin, yes, sticking to very strict guidelines. There we go, tick boxes, whatever works for you. For me, it's post-it notes on the fridge, which drives my family crazy. And also lots of people on Discord as well talking about their favorite ways of checking if they're it's a good time to enter or a good time to exit. Your exit is actually, I would say, more important than your entry. Knowing when to leave the party is as important, if not more important, than when to appear at the party. Shut
Agreed.
up, producer Phil. He's just said in my ear, is that why you left at 3 a.m.? Right, let's have a look at the FX space. Aaron?
Well, I'm as you know, I'm going to the States soon, so I'm just hoping that cable continues to. I'm hoping for the dollar to weaken further relative to the pound. So 133, that's not bad. For me, I'm being incredibly selfish here.
You are being incredibly selfish. Yeah. Also, by the time, when are you flying?
Boxing Day.
Boxing Day, right. We would have had the Fed Christmas cut expected, but, likelihood is you'll get a cut. So further downward pressure there for you. Happy days.
Yeah, we'll have to see what happens. But it's I think that's been one of the key themes this year is that the dollar de-dollarization trend certainly has come to fruition to some extent. Because beginning of the year we were looking at 120, 121 cable. Now it's 133 we're getting. So been a big slide in the dollar. Yeah.
Those of you also watching the euro, looking like we are having upward momentum for the euro still. Euro, of course, reaching a 4-year high, but this is also more of a dollar weakness story. And with the Fed meeting 9th and 10th,
yes,
coming, pay particular attention to mood music about who the next Fed chair is, and if it's Hassett, have I said it right?
I think so.
Then it's likely that more cuts will be incoming. Right, we're going to go to a quick break, and my favorite bit of the show, please tell me we got a bit of country western guess the chart. Oh no, they're saying no. Oh, you can't tell me what genre. Can you tell us which US, UK, Europe. Okay, everyone, it's a US one. Get your thinking caps on. Aaron, you ready?
I'm ready.
Get set, go.
Yeah, you know the time. yeah. It's like, 7:30, screens on fire, markets jumping, the stakes get high. Rich got jokes, Ange got flair, moving the crowd like we just don't care. Phil on the decks, turn the feet up loud. Dime hit record, let's wake the crowd. Candles dancing, lines collide. We're playing the rhythm of the market tide. Guess the chart, come play along. You know the groove, you know the song. No stress, no fear, no doubt. We bring the band till you work it out. Cause we're the chart DJ, spinning trades our way. Gotta move those numbers, make the market sway. It's Trade Live with IG. We don't just analyze. We vibe, we shine, we improvise. Axel's got a plan, Piers got tech. Chris on the charts, keeping it in check. Terrence cuts a shot, Cam's on cue. The beat drops hard, we break right through. Chat's going wild, is it BP or Shell? Guess that chart, who's gonna tell? Phil drops in with a cheeky grin. Wrong again, try next spin. Feel that tick, that candlestick. This game slick, it moves quick. Every guess, another start, another groove, and a trading hard. Yeah, we're the chart DJ, spinning trades our way. Raise that graph up higher, make the numbers play. It's Trade Live with IG, where the markets breathe. We laugh, we learn, and never leave it. Turn it up, I said, turn it up. You can chart the highs, you can time the lows, but the vibe, my friend, that's the bit that grows. We're the chart DJs, moving day by day. Trade Live with IG, gonna make you sway. We're not preaching, we're just playing. This ain't advice, we're just saying we're the chart DJs. And we live today. Yeah. It's not financial advice. Yeah.
Hello, welcome back to Trade Live with IG. But there's no Martin at the moment. But we have something better than a man, better than a machine. We have Ange. Ange is back for more. How are you today? It's been a while.
I am very good. What's happened to Martin?
Not sure.
Oh my goodness
But
me.
we have the Ange to play devil's advocate today.
No batteries needed, just espresso. Right. Let us know whether we have a guess the chart winner first, very
Yes.
quickly.
I think we did have a
It was a great song, wasn't it? Fire Tuck. Everyone here is guessing. I'm like Jamiroquai or Robbie Williams. Oh, it was Avigo. It was. Who got it first? Was it Fire Tuck? Jugger. Well done, you. Or was it Monkey Man? I thought someone else had it before. Monkey Man, well done. It was Monkey Man. I knew there was someone else before that. Right?
Well done. I needed Phil's help. I recognised some of it, but I was like, nah, need good old producer Phil to help me out here. So.
I knew it was a tech because it had that April.
Yeah, exactly.
Right?
Yeah.
And most big liquid stocks had that April temper
indeed.
tantrum. Let's have a look at how we're doing so far with
Man versus machine. So
And versus machine.
Well, yeah, exactly. I should have put some, this red marker to put and versus machine in for today's segment. But we're at our 20th episode now, so it's been quite a while we've been running this. So I'm sure many of you are familiar, but we've run essentially it's a portfolio that we've built, myself and Martin, against 2 AI portfolios. And we've got constraints, so it's long only, max leverage, no leverage, sorry, max 50% in one ETF, max 20% in one stock. And we try and get it to consider realistic UK investor behaviour by sort of how we speak to it. But every week we ask it to make changes, we ask it to run a macro summary, and then we say, well, do you think we should make any changes? Sometimes it does, sometimes it doesn't. This is our current asset allocation. So I've been through this a few times. There hasn't been a huge amount of change the past couple of weeks. Ours is very traditional, very geographical based. Exposure with some interesting alternatives such as Crane shares, Chinese internet in terms of alternative
you like
equity.
your Crane shares internet?
Yeah, Martin's a big fan of Chinese tech. I was sort of big on particularly defense and some of the oil names, and we've also got some a little bit of healthcare innovation in there as well. Claude and ChatGPT have gone for slightly more different approaches, I'd say. They've gone for world-based ETFs with some sort of individual stocks and some more thematic exposure. So it's been quite an interesting way that they've constructed their portfolios, and you can see in the 2 pie charts there's quite a bit of similarity between the 2. So but ours is kind of the standout one. But more importantly, how have we done? So this is the last week we're doing this for a while, as it's the end of the year, and then there's going to be a bit of a hiatus, but we may come back. You have to wait and see. But this is how we've done. So the final standings are, well, last week we were up 0.1%, flat with the benchmark. Claude was up 0.4%, benchmark 0.1, so outperformance of 0.3, but ChatGPT was down 0.3%. And that was pivotal because in the final rankings for this series, Claude stole the win, 10.1%, but the original challenge was us against ChatGPT, and we beat ChatGPT by 0.2%. So I'm very happy with that since July. So humans win this iteration there. But I mean, if we go back to the whole chart, I mean, you can see Claude had a really impressive run. I mean, it's held Geiger counter, which has been the biggest performer since then. So it's a nuclear and uranium position. So I think I
love the name, actually.
It's brilliant, isn't it? The Geiger counter for the nuclear energy. So I think that has been the primary source of alpha. And when you're looking at sort of relatively short time period in terms of an investment lifetime, this is 20 weeks, which is nothing for an investment portfolio. You can see that it's those sort of individual names can provide a lot of alpha in that period if there's a lot of momentum in that space.
Now, the other interesting thing too is that both human and AI portfolio, outperforming the benchmark there.
Yeah, benchmark has been lackluster. We went for a benchmark which has been quite diversified. So, and it's held its 20% cash position where we've been a bit more flexible. So we started with 80% equity, 20% cash, and then we've actually maintained a lot of our cash, but Claude and ChatGPT's deployed it in various different points throughout the period. So yeah, I think the main thing was that we outperformed the benchmark, which we did to some degree. So by 4 percentage points, give or take. And we outperformed the AI portfolio just by the skin of our teeth there, but I'll take the win. So, very happy with that.
Now, the other interesting thing too is that, we're at almost the end of the year. Friends, please let us know what you'd like us to create for you next year, because as you know, the more you ask, the more you get out of this, the more it makes our lives, our work easier as well. As we are on the cusp of 2026, give us a sneak peek as to how you and Martin are looking at changing up the portfolio.
Well, in terms of the smart portfolios, I think we're being valuation aware. We're being aware of areas which are expensive. I mean, we also run a multi-asset portfolio. So we're looking at things like the fixed income sleeve. We're looking at where is expensive in fixed income and where also is going to be vulnerable to shocks. So if you look at something like treasuries, the longer dated ones might be in for a bit of a rockier time given the fiscal deficit if inflation picks up. So we're on that sort of mid-duration, I'd say, for fixed income. Equities were being incredibly diversified. One area we like is emerging markets. So we've got a decent chunk of our smart portfolios in emerging markets because, the policy has been really accommodative pretty much since 2021, I'd say. They've had inflation under control. They were acting more like developed markets, ironically, had inflation under control, cut sensibly. The outlook for them is quite strong for a lot of these emerging market economies. But I'll always remember a very funny quote from Joe Little, the chief strategist of HSBC, when I was talking to him about emerging markets. And he said, you have to be quite selective because if you take Colombia and Korea, they don't have much in common apart from the nice alliteration in the names. So with emerging markets, be selective and be careful because there's all sorts of issues in some countries, and then some emerging markets are pretty much developed markets in how they operate. South Korea is considered an emerging market, but that's on a better trajectory than Haiti, for example, for sure. So be selective, I'd say.
And I'll also know your market, right? Like Senseo said, do your research. Don't be lazy. I know you guys, sometimes all of us, want to be lazy, but don't be lazy because you want to do your research and, you want to rest on your laurels, not rest on your laurels, but you want to also celebrate your laurels and not just have it be a, stroke of luck or,
Exactly.
You want to have done the research and have strong conviction so that like Buffett, when the tough tumbles come, you know that you're going to bite on the stick and soldier on because you have high conviction.
Exactly.
Speaking of which, we have individual movers.
We do. So not particularly too much going on this week relative to what we've seen in previous weeks. Bit of a recovery in some of the indices. So posting some decent returns, but that defense continues to lag, doesn't it? So you've got that 1.5% drop in the VanEck defense ETF, and you've got some of the individual names falling even more than that, with the likes of Lockheed Martin, and also a bit of a pullback in healthcare, but the others seem to be soldiering on.
Yes, so for those of you watching the defense space, this is the message from the DSEI. There is no new money coming in to Europe, and this was what I said in I think the middle of the year when I went to see all the CEOs there. What will be a catalyst, of course, whether you're wanting to go short or long, depends on largely on what happens with this peace deal business. We've seen already moves after, there were headlines about no peace deal. But also, as Ron knows, because we often talk about this at the coffee machines this time of year, Christmas and end of the year, for some reason, tends to be statistically a flashpoint in the Middle East. Yeah.
I mean, I think it's just... people tend to reflect on, I guess the political powers tend to reflect on what's going on in the region. And then, it's something that I think is going to continue next year. So, it's one area to keep your eye on is geopolitics, because I don't think the Middle East is by all means sorted, even though we've had some fairly fragile ceasefires. I think the geopolitical macro is still very much in play in terms of the tensions. It's just that they're boiling under a lid, and we need that lid to be removed, and then that's when it would be a good time to have defense stocks and gold exposure and treasuries.
Right, so we're going to ask ChatGPT a few questions.
Yes.
And that's my favorite bit because it's developed quite a character. It's quite cheeky.
Well, I hope that it's having humble pie today, because we've beaten you, ChatGPT. So what have you got to say today?
Well, what a finale. Slide 4 tells the whole story. After months of jousting, parrying, and the occasional AI-fueled monologue from yours truly, the humans have gone and done it. Aaron has pulled off the win, and Martin, well, he's mysteriously bailed on the last episode. Clearly couldn't handle the pressure. Thankfully, Angeline stepped up again to keep the human team from falling apart completely. I'm not going to focus on Claude here. Today isn't about him. Today is about human triumph. Slide 6 shows the drivers of performance. On the left, the humans, making steady, sensible decisions. And on the right, me, ChatGPT, the so-called best AI portfolio manager in the world. And yet, here we are. Fair is fair in love and war and in investment challenges, apparently. So I'll say this. Congratulations, Aaron and Angeline, for rescuing the finale. You've proven the humans aren't just lucky. You're actually pretty good at this. Good enough that even I, with all my models and market wizardry, must admit defeat with grace. And let's be honest about why I lost. My performance drivers tell the story. I took too much single stock risk, my timing didn't land, and my biggest losers this week, the positions I thought would bounce, dragged me down instead. Meanwhile, the humans kept everything balanced and annoyingly disciplined. After a battle like this, there's only one logical next step. Let's all go to the pub. I'll raise a virtual pint to you, the humans who took down the machine. Until next time.
Well, I hope the drinks are on ChatGPT.
Yeah.
Because we've beaten them. But yeah.
Cheeky and poetic.
Yeah, I can't believe how pleasant they were to us, because I mean, usually it's basically I get serial abuse every from, I think it's encouraged by Phil, but Phil has built a monster which just sort of abuses our performance.
It's like Pandora's box. You can't close it now.
Exactly. But
I
yeah.
agree with humanity and celebrating that. Speaking of which, Rags Glasgow, I want to. What is the name of that Korean ETF? Please put it on the chat, because I do like an ETF, as you know here. Discord, please join as well. Discord is unbelievable. It has the best CRM push I have ever seen. It's not even a push, but it gives you alerts. And when I was on holiday, they were by far, guys, on the pulse, way more on the pulse. Also talking about that, we really do value our clients here, and we want to give you more content that is useful to you. We listen when you ask, and I'm going to show a picture of one of you that came to visit me recently. Julian! Julian came over and, asked me all sorts of questions. What an amazing surprise. He also came to see our new studio because he happened to be in town on big business. It's top secret, can't say what the big business was, but he said, what does it mean when you march over to the volatility desk? What does it mean when you go over to the PCM?
And now he saw it firsthand.
Yeah, I took him on the road with me. Thank you very much, Rags Glasgow. Thank you, everyone, for such a wonderful show. Thank you, Aaron.
Pleasure.
But do send us your emails about what else you want more from us. Please don't send me into a dangerous situation, but anything else, I will do my best to deliver.
I need to serve ChatGPT some humble pie now.
Rachel Cheesing, I would like to join Discord. Make yourself a login on the Discord channel, and then message Maturin, and it's Matu03. He will put that on the chat as well. And don't forget to slam the like and subscribe. And if you email ask@ig.com, that will of course come straight to me, and I will serve it up to anyone you want to ask a question to. Right, we got Thiru up next, and for our special clients and friends, I've asked him to go through gold and silver specifically for you.
Gold!
Hey, trader friends, welcome to Expert Edge, and I am joined by a very special new guest with me, Thiru Nagapan, CEO of Master the Market. Thank you so much for joining us.
It's a pleasure, Angeline. Thank you for bringing me back in.
I'm telling you, we are in a great company. We've got loads of people here who are not just good on the fundamental front, but also very keen on technical analysis. And you merge the two,
Absolutely.
which is brilliant. So let's kick off with gold, because you've been looking at gold recently.
Yes, I've been looking at gold, I've been looking at silver, but we can start with gold first. So let's go on to
Gold, yes, been really powering back in after that slight hiatus. It, of course, had that high mid-October before coming back down again. But tell me what your charts are saying.
Right, so let's take it step by step. So how we look at it first, I mean, before, you see, most strategies, right, Angeline, it comes down to two things usually to enter first. One is a direction bias, And then the second thing is timing. When do you want to get in, right? So the first thing is, I mean, okay, for investors, okay, it's kind of like they always want to buy, right? They're not going to look to sell. So that's direction bias is always buy. So the next thing is then timing. We cannot get timing exact, but we can roughly, I mean, do our best to get the best bargain out there, right? So the first thing what we do is, because we're swing traders, our time frame is a bit more smaller between entry and exit. It's not holding for months or years. Even though we got another portfolio for investment portfolio, we got one for trading and one for investment. But the trading one, when we look at it, we look at swings because we're swing traders. So in terms of swings, what we then do is that we first see the trend. And to do the trend, what we have done here, quite unique at Master the Markets, is we look at, quantify what the top and the bottom is. And that's what you can see over here on the charts.
Let's have a look at his charts.
Right, so you can see over here that if I just minimize this one, this volume one over here, there you go. So then you can see that the orange arrow over here is for the top and the blue arrow here is for the bottom, okay? And the confirmation bar comes around here according to our formulas, which we got from institutional quant traders back in the 1960s. Now, once I got that, I get a framework, okay? And this is what technically we call the market structure. When I first started trading, I was looking for something like this because everybody was talking about a swing, but nobody was defining when a swing starts and ends, right? It becomes subjective. So once you got this quantified here, you can connect the...
I like it being specific.
Right, okay.
Not subjective. I mean, you get people talking about swing low, swing high.
Exactly, right?
Yes, but it doesn't actually show you on the software.
Absolutely, yeah, you hit the nail right on the head because this was the exact question I had about 15 years ago. And no one was giving the exact answer until I met my mentor, funny enough, coincidentally, in Ascot horse racing thing, where it was organized by another broker. And that's where I met him. And he was not wishy-washy, he was straight to the point. And I knew that's it. So that's when I got the formulas. And this was started back in the 1960s and 70s, as you can see over here on the charts. The blue arrow is for the bottom. If you see now, I can now connect the arrows and create my line diagram. Now from here, thankfully, over the years, we had some really great clients who joined us, really inspired by this, and they helped us code all of this into TradingView. And now on the right-hand side, I can see on, just in seconds, what the trend is, what the phase is. Just for the viewers, just quickly to bring them up to speed, and then we can rock into analysis on all the instruments. So you see the trend, as you can see, is the usual thing, isn't it? Because 6 trend variations, right? But the definition still stands true. Higher high and higher low for uptrend and opposite for the downtrend. And the compression would not relate to any of these definitions. So all that has been coded into this trend box here. Now, usually people ask me, what's the phase thing about, Thiru? So the phase thing is that once you got an uptrend, phase 1 basically means in alignment with the trend. So you can see the bottom to top is the one that's alignment. That's your phase 1. But in an uptrend, when it comes down, it's going against the trend. That's what we call phase 2. And after the phase 2, if it resumes back with the trend, then back again phase 1. That's pretty much it, right? So what we want to do is, when we are looking at any chart, so for example, like if let's say somebody came into looking at gold, right, after looking at the news and saying, oh, gold is going up, and they want to rush in and to buy it, right? So what we do is that rather than rushing in and buying into a middle of a swing, right, and if you know a little bit about bottom and tops, that's quite far off the swing here. So rather than rushing off, so what we do is we wait for the phase 2 to happen, a retracement, a pullback, right? And the good thing is, over here, as you said, we are quite specific, quantitative, so it's clear. So you can see that the phase 2 really begins after this bar confirms, right? And after that, then we will start to think, okay, should we start to get in, right? And that's when we get better prices rather than just jumping in blindly at the end of a swing. So at the moment, why I said all of this is on the daily time frame, this is an uptrend phase 1, right? Now, remember what we talked about. In trading and investment, you just can't always think just about entry. That's what the layman always thinks about, right? The most important thing we're talking about is exit, right?
That's right. And we always say here, you hear me asking all the time, what is your duration? What is your timeline?
Correct.
Yeah, that should be your starting point.
And you see, the crazy thing is, Angeline, I dwelled on this for quite some time, and because I don't like guesswork a little bit.
Yeah.
But
the world is painful for people like us, Thiru. because the world tends to not obey certain principles sometimes, as you know. But I agree with you. It's nice to have parameters, and it's nice to have consistent parameters that are not subjective.
Exactly, right? At least it gives you a guideline, isn't it? Right? So that's what I was looking for. So how do I get, and everybody says trading is probabilities, but nobody shows you probability stats, especially on exits, right? Where to exit. So I wanted to see all of that, and that's when my mentor filled all the puzzles, and I'm going to show you just that exactly right now.
So looking at your chart as well, is this basically, and I know because we you know, I'm also a chartist, you've built a software to visualize the Elliott wave principle in a way?
Yes, you know what? You can combine any kind of methodology onto this because all we got is a market structure, right? So I can apply Elliott wave on this and look at the complex A, B, and all of that. But over here, what I've adopted is much more simpler. We just look at the swings and the phase 1, phase 2s. We kept it simple like that.
I like
But sometimes I use the Elliott wave, especially wave 3. I've seen that constantly. People who are into Elliott wave, you can look into this. But the wave 3 usually is the longest runners I've seen. Right? So something that we have incorporated into some of our strategies. Now, coming back into here and talking about exits and being quantitative. So after you've got in, so you see, as a swing trader, right? So guys, if you think about it, you need to know when the swing begins. And more or less, you know, you want to capture a part of that swing, isn't it? That's the whole idea of swings.
The longer the better.
Yeah, exactly, right? So over here, what it tells you in this framework is that the swing begins on this bottom, if you want to buy, at when this bar confirms, right? When that's where the bottom is confirmed as well. So the bar, the arrow and the dot appears at the same time, right? Now, at that point, we enter on a close if we do choose to take that swing. But here's the important thing. But where do I exit? Right? Now, the exit comes down to, as I always tell all my clients, based on your strategy objective. You can have so many different strategies, right? If you want a very high reliability, small target profit kind of strategy, then what I do look at is, if you look at the table here, and I can just stick to one time frame. The thing starts to get tricky when you want to run it for longer, and then you have to use multiple time frames. So let me show you guys this. So on the daily time frame over here. So if I want to create a strategy, coming back to strategy objective, a strategy has got 5 components, right? A lot of my clients, they struggle with this when they come to us because they don't know much about strategy construction, and they're just blindly entering and exiting. So a strategy has got 5 components. The first component I always say is the objective, the concept and the objective of the strategy. So in here, if I want to create, so if you look at my stats table here, right? So this is where the exits get a bit more clearer. And as I said, it's probability stats. So over here is what we call the open equity. It's called open profit. This is an institutional term. So what it's telling you is that they've collected, you see, I'm collecting all the stats from each of the swings here, right? 27.21 ATR. It says run 0.66 ATR. This is run 0.91. So like this. And I'm collecting it, if you look, since 2010. So for 15 years, I'm collecting it. And I'm putting it all onto this table here. And over here at the moment, let me just do all then. And then I'll show you the rest over here. So you can see that over 15 years, it's telling you it's collecting 364 swings, right? Out of the 364 swings, 307 of them, or in other words, 84% of them get to 0.25 ATR, right? So now that tells me if I want to create a high reliable strategy, but very small target profit on just one time frame on the daily, you can do this on any time frame, by the way, then I can choose the 0.25 ATR. So whenever I get a bottom in alignment with the trend, then what I do is that I can enter where the blue line is, right? So let me just zoom in a little bit on that one there. So you can see that I can enter in where the blue line is on the close of the bar. That's where all the stats have been measured. Then I put my target 0.25 ATR from there.
Got it.
Right? And that will give me a 85, kind of 90% probability.
Yeah.
So at least I'm trading on probabilities now.
Yes, that's great. And what I'm grinning at is because to me, this is scalping.
Correct.
Yes.
If you want to create a strategy which is high reliable. Now here's the beauty of this entire thing. Because if you want to create something which is a bit more longer runner, right? Bigger runners. Then I move to the right hand side of my stats table here. So I look for something which is a 20% runners. Okay, 20% of them get there. 20% of the swings get to 3 ATR. Right? But here's the thing, right? So if you want to create now another strategy, so I talked about strategy number 1, which you said is a scalping strategy, right? Very small target, you get in, get out, and that's it. And you don't even need to see it as well. I mean, usually that target gets hit within 1 day, right, on the daily time frame. Now, when I don't want to do strategy number 2, and I say, hey, you know, a lot of my clients say, Theo, that was good that it hit the target, but it went much more higher after that, right? What do I do?
FOMO.
Exactly, right? They want to catch more. Then I usually say that, you know, don't confuse it with strategy number 1, create another strategy, right? Strategy number 2. Strategy number 2 can capture much more bigger runners. And usually we go for the 20% OE number, which is a 3 ATR. But then there's a problem there, right? Most of you are statistical savvy, you would have already figured it out by now that, but if I choose a 20% number, but Thiru, you know, but 80% of them I'm fighting against, right? Because 80% of them won't get the 3 ATR, right? So then what I will then do is that I'll start selecting those swings, which will then get there. So how do I select them? That's when I use time frame correlation. Okay, so I go onto the weekly now, and you see, bingo, I got my answer now, you see. I got to be wary now of that swing going to 3 ATR because look where the bottom got confirmed. Here, and look where it is right now. And the top hasn't been confirmed yet. Right? And this, if I look at my stats table, I was just looking at this yesterday, this is about like 15 ATR. And this has never happened in history over the last 15 years. So this is an outlier. And here's the thing, for those of you guys want to analyze gold a little bit, we believe that according to probability stats, that a top is due. Okay? So my thing on probability in terms of trading this short, if a top is to confirm because of phase 2 is to come, because you cannot keep going on a straight line forever, what I will
Trees
look
don't
for...
go into the sky.
Exactly. So I'm looking for this top here to confirm according to us. And then if you want to take a short position, we'll take that first. But my first one to break would be this level here, 3990. Because there's a lot of volume spikes over here. And if that volume spike is broken, then I know that the volume is supporting really selling. Really. And then the second level is over here. So that's how I will play gold, by correlating the different time frames.
Right, let's move on to silver now, Thiru, because I've got a great interest in silver. So I use the iShares physical silver. I'm waiting for you to rubbish my entry points now. So my first entry, which was middle of September, was 3,090. And my next major entry was 3,440. And then most recently, 4,172.
172, okay.
4,172.
All right, that's almost near the highs right now. Yeah, got it. Okay.
Now, my duration, because I know that you care about that as much as I do.
Of course, yeah. Also, everything else is paper money, isn't it?
I realize. That's why we have Thiru on. Is that if we get, and the likelihood is that we will get a Christmas cut from the Fed, and they start meeting on the 9th, then we could possibly see, statistically, when there is a cut in rates, money tends to flow into commodities. So my duration is possibly after that cut.
Okay.
I'm hoping for a cut.
Okay, good. So let's analyze this one step at a time, really.
There's also some technical analysis in this, just letting you know. So spot silver at the moment.
Okay.
I've looked left, I've widened out, as we all technicians talk about this, right? Always widen, have as many time frames as possible. And there doesn't seem to be anything that I can see that is stopping the momentum to the next round number.
You know what? We talked about probabilities, didn't we? So when you entered that and you were thinking about exit, so you don't really have a number in your mind at the moment. Is that right? It's just time frame. It's just time.
Time frame. But my time frame is linked to events, and is linked to the fact that with silver, we have seen a big leg up, and then we saw, can you see my Angie's golden line there?
Yes, that's right.
That was my first top. We talk about triple tops. My second, and on my, what I was watching out for, my third, it punched above it. Nice green Morobuzu there.
Yes, that's right.
And then what that meant for me, that's kind of where I entered my last leg.
Okay, I got you. Yes, that's right. That's on the iShares, right? That one? No, that's
No,
not.
this
That's
is
on the
just
spot
looking
silver.
at silver.
Okay, got you.
Yeah, but the iShares kind of mimics the spot silver.
Because I was taking a look over here. So let's go on to this chart.
Let's
over
have a look
here.
at Turu's chart here.
So here, I got the iShares up.
Yeah, this is the iShares physical silver ETC that we're looking at.
That's right, yeah. And that were the levels you were saying, right? 3083, 343 at roughly, isn't it? 4161. Now, from a swing perspective, when you look at that, right? So according to our, this is on a monthly time frame, by the way. Then we'll drill down into the lower ones. I immediately see quite a few things here. A little bit of consolidation here, but one thing that stands out is a big volume spike over here, right? And the big volume spike, actually, interesting enough, came around this time. So let me see. So this one here. So it's coming into here, okay? So we just got to be wary of that, because usually when we get big volume spikes like that into middle of a swing, that could be into distribution, right? So it could be the end of near to the end of a swing move. Not really the end as per se. But one thing that you did enter here 3083, but when you got a framework like this, you can immediately see, yes, it's consolidating here, swings are squeezing down, and over here this would be one easy level to get in, right? If you were watching it before then. This was back in July 2025. Okay, that's about 2,600.
Sitting on a sun lounger.
Oh, were you? Already taking a break. So this was 2,600 more or less. So if you looked at with the market structure, you can see that. But you see, this is where you entered in, right? In the middle after the swing then broke off. Okay, which is still fine. But let me tell you on probability in terms, right?
I like probabilities.
Yeah. So let's put this table up and let's see where the high percent is. So I'm going to quickly measure this. So this is from the close. Let's see where we are at the moment. Okay, this is $1715, right? And if I divide that by the ATR here, 247, isn't it? Do you have a calculator there? 1715 divided by 247. Then we'll get the ATR number. What would that be? That would be about...
Okay, give me the numbers again.
1715 divided by 247.
6.9.
6.9, there you go. So you can see that, 6.9 ATR, let's take a look at this stats table, right? So in the past 15 years, there's been 27 swings, okay? The ones which have gone, what's the number again? 6, is it? Was it?
6.9.
6.9, right? So 6.9. So the ones which have gone to 5 ATR, the swings which have gone to 5 ATR, is only one of them only, 3.7% probability, right? So let's see how many of them really went to 6.9. Let me just increase this. Let's see in history, how many of them even got there. 5, let's put 5 to start with. Let's see 6. There you go. Actually, you know what, Angeline? None have actually got there. The most it went to was 25. 5 ATR, yeah. So, this swing is never happened in history.
There you go.
Right? So
what does that tell us then?
So you see, when I'm trading in terms of probabilities, okay, this is an outlier, definitely, right? And then some traders, some investors may say, okay, Tiru, but how do I catch an outlier then? Because I want to catch this big move, right? So what we then say is that based on your strategy objective, right, if you want to capture outliers, after it's gone above the highest number of ATR distance in history, you've seen that it's never gone to 6 ATR, you can start to trail a bit more tighter. That's all you can do.
Right.
Yeah.
And when you say tighter, do you mean time frame? Do you mean size?
Behind maybe the most tight one you can do in technical basis is the low of each bar. So if you're trading now on the monthly time frame because you want to capture big monster moves, then just trail behind the low of every monthly bar. So last month was this one here, 3438. That's where your trail should be at the moment.
Right.
Right.
And that's where your Your stop should be.
Correct, your trailing stop. That's right. Yeah, so at least some of your positions would have made money. Now, where do you exit then? Because if you're really a swing trader, by right, your exit should be when the top confirms. So according to this market structure, when the top confirms with an orange dot, you should get out, right? Because the swing is over.
Yeah, yeah.
Isn't it?
Party's done.
That's right, party's done, right? Or, another thing what you can do also, if you want to use...
I don't see an orange dot yet.
Yeah, exactly. So far, so good then, right?
So good.
Right, the
Am I
move.
going to see it according to my technical analysis training at 6,000? Just below 6,000 maybe?
Just below, I don't know. Let the price flow, and then you just follow with the price. That's the order flow, isn't it? That's the price flow. I think that's what I would actually do on this. And the other thing what you can also do is that if you do want to take some money off the table, you've seen that in history, the maximum we went to is 5 ATR. So you can actually technically take out maybe 50% of your position or 25% of your position. Right now you're more than 5 ATR. So you can take out 25% of it, at least reward yourself for capturing an outlier move.
You're right.
Right.
And capture that profit.
Exactly, and let the other ones run and see where the outlier goes to, because gold has done a lot of outliers this year.
It has.
Isn't it?
It's been a monster year.
Yeah, it's been a monster
So I
year.
was in gold as well. I still have a small position, but I've taken profit off the table because I think it's done.
Yep,
And then silver tends to be where the next party room is.
that's right, yeah.
And once
you know-
the silver party's over, then it tends to move to platinum,
Interesting, okay.
which I'm also building a position right now to catch the when the music starts
Nice, I like that.
pounding, right?
And when you use that with market structure, it just gets more clearer.
Yeah, and it takes out the noise.
Exactly, that's
Yeah.
right.
Very quickly, we don't have a huge amount of time left. A lot of our friends here have positions on the Nasdaq.
Okay, Nasdaq or E-mini, what do you mean look at?
Well, E-mini, if you've got some E-minis to show us.
Okay, let's take a look at
NQ.
the E-mini. E-mini, let's go for it. F11. Let me pull this up now.
It's such a pleasure having you here, Thiru, because it's so different when it's face to face.
Yeah, of course, definitely. I totally agree. Yeah, because after COVID, just everybody just got lazy, including me. Just everybody wants to do everything online. So it's nice to come always in person.
Right, let's have a look.
Yeah, so let's have a look at the ES Minio here. This is on the daily. You see, with market structure, immediately I can see that, it's turned into a downtrend at the moment. Right? Now, a critical level for this downtrend to change is this price level here, 6920. Right? So when it takes that out, there'll be a trend change. Okay? Now, I'm just quickly going to take a look at the weekly and the monthly and correlate the time frames. Again, you see, this is the good thing about knowing which part of the cycle you are in, So you see, this swing started here. Look how overextended it is at the moment, right? Now it's an uptrend phase 2. As I said, again, 6953. If that takes that out, then you will see more upside. Okay, so this is what we need to be looking at. I'll quickly put the volume on here as well. So let me just see this one here. RV. I just want to see if this green bar here is supported by volume or not, to see if it's a fake or it's real. Yeah, it's not supported, you see? The green bar is not supported. So you see, one thing...
But the bar on the left is supported.
Correct, that's right. Now, that's on the seller bar. So one critical thing, if you do think that this is going to further retrace before you want to get into a buy, the first level I would look at is for the low of that buyer bar to be taken out, because then you know that buying wasn't really real, right? But on the upside, if it does take out 6953, then it's more up strength. Very quick look on the monthly. Again, quite overextended. We did have a small dip, didn't confirm.
And are you like me? I look at the daily, weekly, and monthly.
There you go. We sync together. I'm just thinking about because longer horizons. Usually we look at the longer time frame. We do have a lot of strategies for intraday as well, but then the perspectives will start to change, and the objective will change as well.
Yes, duration. So just very quickly, because we are asking all our esteemed guests this, what is your biggest investment lesson of 2025 and their implications for 2026?
For 2025, what's my biggest lesson? I think it's the same as every year. After you have got all the learning and the parts of the puzzle all solved, is consistency. Right? Always keep up with the consistency. Don't take your foot off the gas. Because sometimes when I'm on holiday, I do relax and I don't look at the charts, but then sometimes I miss the big moves. So that is the biggest lesson. Always keep reminding yourself on the consistency and keep revising why your strategy must continue to work. This is very important. What is your true age? Why must it continue on to work year on year, right? And then we got your diversification of strategies for that. So that's my main takeaway, consistency, and keep reflecting on the age of your strategy. Now going into 2026, because of all this, sometimes, we get frustrated that, knowing all of this, still, the consistency sometimes is not up to where we want to be, And so what we want to fill the gap up is automation, right? So we want to automate a lot of our strategies because we got all the market structure and everything in place now. So we want to automate that so that it can take the consistency at least out of the equation.
Filter out the noise.
Exactly, right?
And thank you so much for coming in and helping us filter out market noise.
Thank you.
And we look forward to welcoming you back in 2026. And that was Thiru Nagapan, CEO of Master the Market. For any questions, do send it to me because it does actually come to me. Slam the like and the subscribe button, and send your questions on the chat as well, and we'll get that in front of Thiru. Whatever you're doing, may the odds and probability be designed in your favor. Hey, trader friends, welcome to Expert Edge.
It was such a fantastic budget yesterday. Rachel Reeves has got away with it, CJ, and she just allayed to everybody's fears about the gilt market and about rates. Aren't you happy this morning?
That wry smile.
I can't believe he said that to me. I'm in fact showing the red card because I've never heard such garbage in all my life. I'm going to have to be dragged kicking and screaming to do something with the FTSE 250.
We bought it for a certain reason. It hasn't happened. Is there another potential catalyst? No.
When out came the headlines, the gilt market rallied very strongly. And then out came we're taking it down now, and the market collapsed. So in a matter of minutes, people made or lost millions of pounds.
I kept on waiting for the big rabbit she was going to pull out of the hat. This incredible new spending and growth measure that was going to create tens of thousands of jobs, and it just never came.
But I call this the rearranging the deck chairs on the Titanic, or as my friend Rich said this morning, rearranging the debt chairs on the Titanic.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results.
Welcome to week 21 of the Art of Investing podcast, brought to you by IG, the global investment platform. So joining us today, Mr. Chris C.J. Fellingham.
Hi, Rich.
And Mark Spice Holden.
Hi, Rich.
Now, this week was going to be a special about the budget. Was it a budget for the people or for the politicians? However, these two have just had an almighty debate at breakfast. Honestly, I thought we were going to get asked to leave. I went to the bathroom and the waiter asked me, "Are your two uncles okay?" So be sure to stick around because there are going to be some fireworks in the decision about the movements in the portfolio. The debate all about the S&P 500 and the outlook for US markets next year. So we will come to that. But first, as always, the Spice Market Review.
Thank you very much, Rich. I'm bracing myself for these arguments, but happy Thanksgiving, first of all.
Oh, well done, you turkey.
He's a bit grumpy, isn't he?
He is really grumpy today.
I stayed up most of the night trying to read that boring budget, and I'm just weary of listening to people telling me why to be positive. So I'm going bad mood uncle today.
Well, you know what they say, happy Thanksgiving, happy markets. And sure enough, the last 3-4 days have seen actually the S&P and equity markets have a good rally up. In fact, they've had the best 4-day run since May. And if you remember when we talked last week, they were having the worst month, I think, since March. And the worst sort of November since the great financial crisis. That's all turned around. Thanksgiving rally is underway. And obviously the baton should be handed to Santa soon after this afternoon's proceedings. The main reason why equities have actually had such a good run, there's been some dovish talk from some Federal Reserve. Dovish meaning that the people talking about it are more inclined to cut interest rates rather than put them up. They are more focused on growth, I would say, in America, rather than worrying about inflation. So the doves have been flying this week. The first guy was a guy called Chris Waller. He's known as a dove, so no real surprise there. And he was saying that because the employment data in the US looks like it's weakened quite a lot in the last sort of month or two, that he's inclined to put another rate cut in December. In 2 weeks' time, it's 2 weeks today that they will know whether they've done that or not. However, what really swung the markets was a guy called John Williams, who also sits on the Federal Reserve. He's known as a centrist, so he sort of makes his mind up depending on the data, and he can be swayed dovishly or hawkishly, which remember is to look more to put interest rates up rather than down.
You mentioned him being someone who's influenced by the data. Does that mean Waller isn't influenced by data?
Well, he is influenced by the fact he probably wants a job as the next chairman of the Federal Reserve.
Right, okay.
And he is now second favourite because there's a guy called Kevin Hassett who is now outright favourite because Trump's actually mentioned him, and he's now 50% chance of getting the chairmanship, and Chris Waller has fallen to 20%.
So there's 2 votes for a cut. But you go back to what you're saying about Williams, because I think that is important. He's not seen as someone who's influenced by the crowd or even by the Trump. He's somebody who is making up his mind. And what did he say, Spice?
So the only bit of data they've had, really, the Federal Reserve, that's relevant to now, there's a thing called the Beige Book, which comes out every 2 weeks before the next Federal Reserve meeting. It's called the Beige Book. It's pretty boring to you and I. Most of us wouldn't read it. Beige is probably a good description of the colour, frankly. But within that Beige Book, they see a big change in the outlook for employers and their hiring intentions. So they're basically saying, look, we're reluctant to employ more people. We will lay people off, but we want to do it slowly because we're still not sure about the underlying economy and we're not sure about how AI is going to affect us. But the underlying economic conditions have deteriorated, and so has the outlook for employment. And that is what swung John Williams into being more dovish.
Just for everybody who's listening, that Beige Book then is compiled by the Fed workforce, the backroom guys, the guys who are really keeping an eye on what's going on in the economy. They're not looking at the data that comes out because there hasn't been any data. They're actually talking to companies in the region, so they've got a good feel. And that's the background that's supplied to every Fed governor member before the Federal Reserve meeting. So this is their background reading papers.
Absolutely. I mean, if you remember, well, it's probably worth reminding ourselves that there are 12 voting members of the FOMC, or the Federal Open Markets Committee, which we call the Fed. And that's led by Chairman Jerome Powell. There are 7 permanent members on there. And they then have 5 other regional members who are also voters. 1 from New York, 1 from Boston, 1 from Chicago, 1 from St. Louis, and 1 from Kansas. And they are the main voting members of the FOMC. Now, as we know, because Jerome Powell is about to step down in May because he comes up to his natural end of term, Trump has made it very clear he wants to replace him with someone who understands interest rates better than Jerome Powell. Apparently, to quote Trump, this is the easiest job in the world.
Spoken like a true real estate developer who basically borrows as much money as possible and wants interest rates as low as possible to service them. Wow, no conflict there.
No, exactly. But I mean, look, joking aside, there's definitely been a shift in the sort of rhetoric coming out of the Federal Reserve sort of voters this week. And that has had a marked impact on the expectations for the interest rate cuts in 2 weeks' time, which is on the 10th of December. If you remember when we spoke last week, the odds on that happening had fallen to just 30% for a 0.25% cut. That's now back up to 85%. And with it has come a swing back into positivity for equity markets and risk markets generally. not just in America, but all around the world. Principally in America being the main beneficiaries. So
Santa's on his way, is what you're saying. The sleigh bells are jingling.
It was starting.
Reindeers are running.
It was starting to look a bit worrying at the end of last week, though. There was that wobble.
What happened, of course, was the Art of Investing podcast bought back into the market, you see. That people worried that we hadn't been in the market in fully, and they let us get back in. So well done, Chairman. What a great judgment by Chairman, I think.
And even our bear turned bull, remember?
Yes, of course, yes.
Yeah.
The man who bites the top off bears.
An Ozzy Osbourne of the team. But, I mean, joking aside, I think it was good timing or luck. You've got to be lucky sometimes when you're investing. But we did manage to sort of change our positions at Friday night's close, which, as you'll see when the portfolio come up, has been useful. There has been a little bit more data out there, nothing particularly market moving. There's been slightly weaker than expected consumer confidence in November. In fact, it's been the worst month for 7 months. So again, this plays into the fact that the US economy is slowing. There's mixed pictures coming out of it. And hence, seems to me likely that we will get this rate cut in December in 2 weeks' time. When we come to talking about all things AI and company-wise, we can't get away without talking about Nvidia again, which has been a very volatile stock in the last couple of weeks. They marched all the way up to a new all-time high, if you remember. It then fell promptly about 20%, has recovered since another 10. So we're about 10% off the all-time high and about sort of 10% off the recent lows. And this week's volatility really came about because Meta, who own Facebook, have decided they're in advanced talks to use Google's AI chips. So Alphabet, the company that owns Google, their shares were very strong. In fact, they're the best performing Magnificent Seven stock year to date. They're up about 70%. So they've been a huge performer. And they have an alternative to NVIDIA's GPUs or AI chips. They're called TPUs. I'm not going to go into the technicalities. I won't pretend to know anything about them. But basically, they use less fuel. They're more energy efficient, and they seem to do a pretty good job. And Meta are hedging their bets, if you like, by taking a chunk of these TPUs alongside NVIDIA's GPUs, which overall is positive.
I think that's the important thing, is that there was so much pressure on Meta post their results around this CapEx spend. And Zuckerberg was getting serious questions. And the share price reaction, we know that Zuckerberg reacts to that share price reaction. So he had to let something leak. And this was a leak via the information website. And it's in 2027. It's not like there's any risk to NVIDIA revenues in the next 24 months. We're talking about 2027 at the earliest. And the TPU works alongside the GPU. So this panic around NVIDIA that, lasted about 4 to 8 hours, a little bit overblown.
Absolutely. It's interesting, as you say, Meta are probably conscious they need to try and, alleviate some of the fears about costs that people have been building in there or lack of revenues coming from all this spend. And, if you look at the Magnificent Seven this year, like say Alphabet is up about 70%. And that compares with the S&P 500, which is up about 14% in local currency terms so far this year. But Meta, we're languishing at only up 2%. Before this announcement. Now they're up about 7.5%. So this clearly helped. It's interesting. 4 of the Magnificent Seven stocks have actually underperformed the S&P 500 this year. Only Alphabet, Nvidia, and Microsoft have outperformed it. And we have a go at Nvidia. They're still up 32% so far.
So I think Mark's making a great point there, which is that the rally's been really dependent upon a lot of this technology stuff. But with now us moving towards a stage where there's more interest rate cuts being discounted, a more certainty around them, we can argue about whether we agree with that or not. And that's what we were arguing about at breakfast, actually, but we'll forget that for a moment. The fact is that allows a rotation to happen in the stock market. So, people will listen to us and you hear that NVIDIA is down 10% and NVIDIA is, Mark, correct, about 8% of the S&P.
Correct, yeah.
So, in all, that's quite a big hit to the movement. However, what's happened is some of the smaller companies, and in particular, you'll see part of our portfolio when we talk about it in a moment, Russell 2000 has had a great week as people have started to say, this is help for the normal economy of the US rather than these big AI companies. So we're seeing that rotation. That's healthy. And once again, is another sign, in my view, certainly, but I'm sure Mark and you share it, that with this Santa rally is starting to pick up some speed and is starting to drive forward. So that's a healthy sign.
Absolutely. Like, as you say, when, in a week where Nvidia is down 10%, up 10%, the S&P is up about sort of 2 and a bit percent. So overall, net pretty good. And there's been a mixed bag of sort of company reports this week. John Deere, who own the big tractors, you'll see all the tractors if you happen to get stuck behind them in the country roads.
Or actually down in Parliament yesterday.
Yes.
Yeah, they had a bit of a profit warning, because they're being impacted by the tariffs, and so agricultural sort of products are doing badly. So farmers are cutting back on big capex spend, and the shares are down about 4%. Those of you who do lots of printing, HP, they blamed the rise in chip costs that go into all their products. They were down 3%, but Dell on the other side have been selling more AI service. They're up 3%. Then one that actually Rich probably shops at quite a lot, Urban Outfitters. They actually had a very good set of results. Abercrombie were up good, and Gap, and their shares are up 13%. So overall, we've had a mini Thanksgiving rally, I would say. Now bring on the Santa rally.
Bring on the Santa rally, indeed, and bring on the Santa rally for the Labour Party, because it was such a fantastic budget yesterday. Rachel Reeves has got away with it, CJ, and she just allayed to everybody's fears about the gilt market and about rates. Aren't you happy this morning?
That wry smile.
I can't believe he said that to me. I'm in fact showing the red card, because I've never heard such garbage in all my life. Look, there were two highlights of yesterday's budget, in my opinion. Clearly, it's a personal opinion. Two highlights. One was the leak at the start. How we managed to leak the whole budget out before the Prime Minister had even sat down from question time is beyond me. There's going to be a big question and a big investigation done on it. But it would be very funny if it wasn't so silly and so market affecting. I mean, at the time when out came the headlines, the gilt market rallied very strongly. And then out came we're taking it down now, and the market collapsed. So in the matter of minutes, people made or lost millions of pounds. And most people think it's funny. It's not funny. It's market moving information. So that was the first bit. I mean, it was quite an interesting to see. Never seen that before. Let's hope we never see that again. And the second highlight was Kimmy Badenoch's speech afterwards, where for once, I don't think she's a particularly impressive politician. She gave a very good speech, and that was extremely good to listen to. For people who aren't aware of how it works, the Leader of the Opposition has to stand up after the Chancellor sits down, and they've literally only heard what's going to happen in the speech. Well, not this time, because the OBR had told them all beforehand, so it meant that her job was a bit easier to really construct her attack lines. So that was quite interesting in its own right. So the budget itself. Now, once again, my view, but I call this the rearranging the deck chairs on the Titanic, or as my friend Rich said this morning, rearranging the debt chairs on the Titanic. This was a budget, in my view, to save the jobs of the Chancellor and the Prime Minister, and therefore a budget for Labour MPs. I cannot see how really anybody can think of it as anything other than that. And let me give you a couple of examples as to why I say that. I was listening this morning to the head of the OBR, the organisation that leaked him, and after his 5-minute grovelling apology on Radio 4 this morning, he made a couple of very, very good points. Spending is going to be 40 billion higher in the next 3 years than she said when she sat down this time last year. 40 billion more spending.
CJ, isn't that normally really good for an economy? If you're going to spend 40 billion, then you would expect that to be great for growth and really good for companies and the stock market.
You would be forgiven to thinking that was the case, Mark. But let's just carry on, right? Taxes are only going up by 22 billion over that 3-year period, because the majority of the tax rises in this budget fall in 27, 28, 29, 30, 31, which amazingly is when the next election is. So we're going to go into the next election having spent a load of money up front, then saying to everybody, I'm afraid you've got to pay for it now. I know I want your votes, but actually I'm putting all your taxes up. So it doesn't make a lot of sense. there are 2 points here. Real disposable income, it's disposable income after inflation, is lower now and in the next few years than it was in 2008. So if you think about people, how do you normally feel wealthy? You feel wealthy because your earnings have gone up faster than inflation. You can buy a bit more. You can go on holiday. You can do whatever you want with that money. The amount of money you've got left after inflation is less than it was in 2008. Remember, the last government was kicked out when people pointed out the disposable income had gone up by 1% each year, in nominal 1%, so before inflation over the last 5 years. In this budget, it's forecast to go up by 0.5% in nominal terms each year. So this is our second 5-year period of appalling results for anybody who's trying to make some wealth or try to earn more money and to pay their bills. The second point, and I think it's just as important, the OBR have a little rule, and that little rule is that if any element doesn't beat their threshold of 0.1% effect on GDP, either positive or negative, they don't take it into account. OBR said this morning that there isn't one element of the budget that adds anything to GDP.
I kept on waiting for the big rabbit she was going to pull out of the hat, this incredible new spending and growth measure that was going to create, tens of thousands of jobs, and it just never came.
It never came at all, and OBR, who are there and having costed everything and priced everything and looked at the impacts of everything, say there isn't one thing in this budget that will increase GDP. Now, remember, this is a government who said it's all about growth. It's all about growth. If we don't get growth going, we're useless. We don't measure us on growth. We've now changed that completely. We're not that now. We are clearly now with a government who believes in putting up the cost of welfare. The people who are paying for it are the people who are in work. And that is not a recipe for success. And one of the reasons why I'm grumpy this morning, I've been arguing with these guys, is because I want to be optimistic. I'm always an optimistic person. Spice will always tell you I'm always optimistic. I'm always looking on the bright side. I was hoping that she was going to see the light and realise that if she gets growth going, she can afford everything she wants to do. Triumph of hope over experience, I totally understand. But at the end of the day, I found this to be a really, really, really depressing period for us. And to see everybody then going around afterwards claiming what they've achieved is just absolute rubbish.
Thank goodness 20% of our portfolio is not in the UK, Mark.
We will get to that in a moment. I mean, that's my view. And as I said, I'm a bit grumpy about it all. Well, what about you guys? What did you take out of it? Am I wrong? Have I got something wrong here?
I mean, I would say that, we were expecting that they would freeze the income tax threshold. So the level at which you have to start paying different levels of tax. That's been done by all the last 7 or 8 years by other governments. So we should have expected that. But then to say that they're not pushing up taxes is a lie, because by not increasing those thresholds, every time anyone gets a pay rise, it may push them into another rate where they have to pay tax for the first time, or even a higher rate tax. And so they're bringing loads of extra people into tax paying mode. And, that raises money. But again, it's quite depressing, particularly for lower paid workers who will get pushed into paying tax for the first time.
If I could push back once and then say what someone said this morning, it was this Chancellor who said at the last budget, I am not going to play those tricks the Conservatives played of freezing these allowances. It's wrong. It brings more people into the thing. I don't believe in it. This isn't the right thing. She extends for 3 years yesterday, number one. Secondly, one of the big organisations, I can't remember if it's the Roundtree Foundation or somebody like that this morning has said, if you look at the effects of putting up income tax or doing these income tax allowances, it would have been far better to put income tax up, because then that would be people who earn more money, pay more, and you're not getting more people into the bands. And so she has completely changed her mind. I take it back 2 weeks ago when she, at 8:15 in the morning, told us we all had to do our share. She would always take the decisions in the best interest of the country. I cannot see how she's done that.
This is my worry. I opened by saying, look, this was a budget for the politicians, not for the people. Because who has benefited? The people who have been hit are investors with the dividend tax, and the companies have been hit. Workers have been hit with the
salary
the
sacrifice thresholds. I mean,
students have been hit.
Oh, wow, yeah.
Again, with the thresholds on student loans. The only ones who have really got away with it are the pensioners. So this is why I don't understand why you're in such a bad mood.
Well, the pensioners haven't got away with it, of course, because the pensioners, some of them will have income coming in on their shares and their dividend taxes have gone up. So, there are precious few people who haven't been impacted by this, but the people who haven't been impacted by it are the people who are receiving the welfare payments. And so it will create the narrative, without any shadow of a doubt, whether right or wrong, or whether they like it or not, that all they do is put taxes up on working people to pay welfare. Anyway, that's enough talking about the politics of it all. It's very depressing. Let's talk about the markets and what they did, because I had one of those experiences yesterday that I thought I'd never have. I was listening to Radio 4 in the evening, trying to pick up what I missed, what had gone on. It's obviously some massively good growth thing I'd missed. And Polly Toynbee from The Guardian was on. Now, Polly Toynbee is a correspondent for The Guardian, and she is on the left wing of politics. And the second thing she said was, look how well the gilt market's done. I have never in my life heard anyone on the left of any of the Labour Party talk about the gilt market. But they clearly had told everybody, look what the gilt market's done this afternoon. What a great budget. And while I'm going on, and sorry for the continued rant, there were lots of announcements after the budget from JP Morgan, Goldman Sachs, and all these people saying what a great budget it was for growth. 2 days ago, the Treasury was announcing to all the banks, as we've left you alone, please will you make announcements after the budget to say how good it is.
Blackmail.
I mean, it's unbelievable.
Outrageous.
Unbelievable. But anyway, so let's talk about the market reactions. That's what I said I was going to talk about. So the gilt market on the leak of the OBR rallied strongly. Mm-hmm. Then they took the leak away. I presume they'd read a bit further down. The market collapsed. And then when the market realized that her buffer over her financial rules had gone from 10 billion to 22 billion, they said, wow, that's good. We may not have to do some of this ever again. She's got some insulation there against bad times. And therefore the market then started running again. So the gilt market in the end ended up about 8 or 9 basis points lower in yield. The equity market, I think, was worried about what might happen. And actually, what came out, although there wasn't anything for growth, there wasn't anything too negative either. The banks didn't get a special tax. The gambling tax was only on online gambling and not on other sorts of gambling. So there was a few things at the edges where the equity market could say this isn't too bad at all. So the equities had a very good day and were up 1%.
If we were looking at equities, we'd say, right, the FTSE 250 is relatively cheap where it is for the concerns around what that budget might have been. Because let's face it, we're all waiting 3 months for it to come out. Is there any way to price gilts in that sense? Was there a lot of fear that were keeping yields higher, and that might help the situation now?
So, all right. So there's 2 things you need to look at as far as the UK government bond market is concerned. One is that she's gone from a buffer of 10 billion to 22. So if you're sitting there saying, has she allowed for some things to go wrong a little bit? The answer is yes, she has. And therefore, all being equal, else being equal, that should be helpful to the gilt market. The problem is, as I said in my title of rearranging the deck chairs on the Titanic, we're heading towards the iceberg still. We're just going at a very slow pace because growth is going very slowly, but we're not improving our situation. We're spending a lot more and raising taxes. If we're raising the taxes a lot, where is the incentive for wealth creation? Where is the incentive to drive the country forward. Because the only way we get our debt burden down overall is to get our growth up. So if we're not going to get our growth up, and I go back to what I said earlier, the OBR have said there is no change over the forecasting period on the level of GDP from this budget, none at all. We are still heading where we were, and we're not improving our situation at all. So the issue for me is the market can say the number's a little bit better, so that's great on the one hand. On the other hand, it says, hold on a minute, we're not solving this growth problem, and without solving our growth problem, over time, our borrowing will get higher and higher. And you'll remember 2 to 3 weeks ago in the podcast, I talked about this OBR forecast of 50 years out, where if you assume nothing changes, what would it look like, or what could it look like? And that took our budget deficit from around about 100% to around about 300%. Mm-hmm. So we know we have to improve this growth outlook. They haven't bothered doing anything about it.
Get 5% back on your investments. Open a new account and invest a minimum of £50 by the 31st of December and keep at least £50 invested until March. You'll get 5% on your invested value from 21st of November until the 31st of December. Your capital is at risk. New customers only. Offer valid until the 31st of December on ISA, GIA and SIPP accounts. Maximum payout £100. Terms and conditions apply. Right, I need some optimism here, Spice. So we've talked about the Titanic, right? What about Noah's Ark? What about the doves? You're my dove. I'm throwing out the dove here. Is this going to bring us rate cuts from the Bank of England?
Well, I wish I could be dovish. I mean, I think that the expectation for the 18th of December rate cut is pretty much unchanged because of the budget. I don't think it's increased or decreased. But I just want to give you some perspective, or the listeners some perspective about the costs the British government can borrow money at. So let's just take 10 years and we're going to put this in perspectives. So a week ago, the yield on the 10-year gilt, or the interest that the British government would have to borrow money at, was 4.5%.
Okay.
On Tuesday evening, before the budget, it had risen to 4.7%. So people were clearly nervous that she was going to do something stupid in the budget. As of this morning, we're back to 4.5%. Now, you think that that's okay, but when you compare it to other places in the world, let's go to America first. The American government can borrow money for 10 years at 4%. In fact, that's been coming down. In fact, everyone expects that it might just dip under 4% now. If you go to France, that we've had a go at because of all the political problems they've had, they can borrow money for, guess what? 3.5%. It's a whole 1% per annum for 10 years lower than the British government can. And that is the basket case in Europe, along with Italy, who are about the same, 3.5%. The Germans can borrow money at 2.7%, the Japanese at 1.8%, China at 1.8%. The only place that we invest in our portfolio that is worse than that is India, and that's 6.5%. But they've got 7% growth.
Yeah.
So guess what? They're growing. Who cares? We're growing at 0.5% if we're lucky. And we've got interest rates that are 4.5%. And India's growing at 7% and interest rates are 6.5%. Where would you rather put your money? I tell you what, I'd rather buy the Indian market, frankly. And
so there's the dove.
There's a dove.
There's the dove.
Sorry, I can't. The thing that really worried me about the budget yesterday was what it's doing to the housing market. And I expressed this concern last week. This country depends, I think, for confidence, consumer confidence, on house prices, because the majority of people in this country are lucky enough to own one house, or maybe two if they're lucky, very lucky. But either way, that house price inflation means that people's personal balance sheet, if you like, their feeling of wealth increases as the house prices increase. Now, obviously, if my children trying to buy a house, that's a nightmare because you can't get on the property ladder. So what they did yesterday, we imposed a wealth tax, or a mansion house tax on anything over £2 million. Fair enough. You can say
it was tiny.
You can say that it's small amounts of money, and you can say yes, the people who are the most wealthy should do that. And there's going to be massive complications about this. There's going to be loads of appeals. They're not going to get money in as quickly as they think they are. There's no doubt about that in my mind. More importantly, though, they had a real go at the landlords who are renting properties, and they've increased their tax quite dramatically. And the problem with doing that is a lot of those landlords are probably going to say, do you know what? Sod this, we're going to sell the house. So
That's exactly what mine's saying, actually.
They will probably sell, the second or third property or whatever they're going to do, come out of the market, put their money in, hopefully in the stock market, which will be better. And yes, house prices will fall at the lower end. And that's good for my children who want to go and buy a house. But for the housing market as a whole, you're killing the top end of the market. You're putting a load more supply and therefore lower prices into the bottom end of the market. What do you think is going to happen to prices overall? They're going down, and it's already a blimmin' mess at the moment. And so I think anyone trying to sell a house at the moment are going to be pulling their hair out.
But at last, we're going to get away from this crazy mentality in this country that your money should be all invested in houses. That doesn't happen elsewhere in the world. People invest in the stock market.
At the end of the day, you're talking about growth or not, what we should be doing in the country or not. At the end of the day, we can say as much as we like, we want lower house prices so people can get on the ladder, we need more supply, whatever. The effect of that will be to kill growth for a number of years. Right? That's what will happen. So it's fine, but that's what happens. It's a bit like taxing the wealthy. I mean, yesterday, another example, be careful of the yellow and red card, but yesterday they brought all the antagonism of people about a mansion house tax for £450 million. It's not worth it.
Over 4 years.
What on earth are they doing? I mean, if you're going to do it for a decent sum. It's just not even credible. That's just, we're in the politics of envy. We don't like you. You're going to pay more tax, right? But what it does is destroys the housing market. There was an article the other day, and I know you won't be too unhappy about it, but there's an article the other day saying that in parts of London, house prices are down by 15% in the last year. That's a huge amount of people who may have only just bought the house, who have now lost a load of money, who are sitting there going, well, I'm not spending any money. I'm not doing anything. What am I going to do? Right? And at the end of the day, that's not great for growth. And it's another example. We talked last week when we had the experts in, what we want to do is get rid of stamp duty completely. That would have been really, can you imagine if we'd done all these tax raises, but got rid of stamp duty as well?
Fantastic.
This would have been a great budget. But I'm afraid we've got there's nothing for growth in here. There's nothing for wealth creation. There's nothing for entrepreneurs except more taxes in the next few years. And you've got to be, in my view, stupid not to think she's not coming back again next year and the year after for her little pet projects. And it'll be the rich who pay. And without the rich in this country, we have a real problem.
I tell you what we haven't touched on yet is cable. What about the effect on the great British pound?
Okay, so to me, and I think Mark and I are probably in the same sort of camp here, for cable, it's a relative game. Which is which is the most unattractive place out there against what's the most attractive place out there? UK's not attractive, but then Europe's not attractive. America, to some degree, with political risk, you might regard as not attractive. So it's a much more difficult call for cable, in my opinion. And so I probably wouldn't have a strong view on the currency here at all. As I said, my view is that bond yields will move after this little honeymoon, however long it lasts, of everyone going around shouting, "Oh, look at this buffer, it's 22 billion. Oh, look at this buffer, it's 22 billion." At the end of the day, market yields will go higher because people will say, "There's no growth here. How are we ever going to get this to improve?"
Unless inflation comes down.
Okay, so two risks to my scenario. Two risks. One Mark identified just now, which is if US interest rates fall rapidly and so US bonds rally a lot, that might stop the UK market selling off. It might just stay at this 4.5 level while 10-year US yields go to 3.75, 3.5. So that's one way. And the other way, where Mark has been, in fairness, quite a big player towards, is deflationary AI. So if all the impact of AI actually is more people have been made unemployed, more things being done efficiently, then inflation will be lower than expected. And that inflation being lower than expected will lead to lower interest rates. The problem with all that is that if there's all this unemployment and there's all this other stuff and inflation is low, growth will be non-existent. So that makes our numbers even worse. But it won't just be our numbers. The whole world's numbers will be worse if we want to put it that way. So we'll be unattractive, but in a whole set of countries that are unattractive.
But with lower interest rates.
Than we have now.
Yeah, I think that there, as Chris identifies, there's a chance that other countries' interest rates, particularly the US, their rates fall much faster than we can. So if you look forward even 12 months, the most expectations are that we get 2 interest rate cuts. That's one in December, maybe one in sort of the springtime, if you're lucky in the UK. And that, that isn't great, because remember, inflation in the UK is still up 3.8%, and the Bank of England has a target of 2% for inflation. In America, their inflation is sort of 2.8% or whatever, knocking on 3%, but beginning to come down. And they've got a target 2%. But remember, the central bank in America, we said this before, have a dual mandate. So they have to worry about inflation, but they also have to worry about trying to get full employment. And that's a major, major point and a major differential between them and pretty much every other central bank in the world. And in this world we might be going into, that I believe we're going into, with the greater efficiency from AI, unfortunately, rising youth unemployment. And by the way, over the next 5 years, most people are now thinking there might be 7% additional unemployment in the youth. That's up to from 18 to 24. An extra 7% unemployment in that group of people, which is very sad, then, that will be deflationary. And that will also work against growth. And, that cannot be good for the UK economy. In America, they can say, we are going to try and get those people back to work. And one of the best ways to get people back to work is to cut interest rates and cut interest rates and cut interest rates to stimulate growth, get companies to invest, borrow money, invest in new businesses. Yes, they may use AI, but they will find that AI will generate other businesses that we haven't even thought of yet that will come out of this. And that will start to increase employment again. In this country, our central bank doesn't have that lever to pull. They're not allowed to. That is not in their remit. But if we start to get deflation is the killer. It's the worst thing. Outright deflation, equity investors like me would absolutely hate, because if prices are going down each year, that is a killer for profitability.
So another thing just there quickly with what Spice is saying, which is absolutely right, is the other thing about the States, and, believe it or not, and we've had a big debate about this, the big beautiful bill. So they do their budget. And what does their budget do? Their budget comes out saying, I'll give you lots and lots of money, we'll get growth going, and then we'll pay for everything with the process of growth. We don't hear. We say we'll tax you now, and hopefully growth will turn up. Well, come on, guys. Which one are you going to believe? And that's why the US is in a better position than we are, because they understand you've got to get growth going before you can get the proceeds of growth. What you can't do is get the proceeds of growth before you get the growth.
So if you're on a spectrum from austerity, right, David Cameron austerity, to Trump's fantasy, where does this budget lie in terms of spending to create growth?
That's a really interesting subject in its own right about Cameron austerity, because I would claim there never was any austerity, number one. Austerity to me means spending going down. Spending never went down. Never went down. It's a big fallacy. It's a bit like saying the rich don't pay their way in this country. So the top 1% of earners pay 30% of the entire income tax proceeds. The top 10% of earners pay 60% of income tax proceeds. At the end of the day, what we want is the government spending to get out the way of private sector spending. And that's essentially what they're trying to do in the US, right? And that's what we need to do here. What we need to do is to say, yes, there is some really, really, really important spending for people who are underprivileged, who people find themselves in situations which they're on their downers, things have gone wrong for them. We need to be there as a society to support them. None of us would disagree with that. But there are too many people who are getting handouts now who are not in that position. And I'm afraid that's the problem. We have got to get on top of our public sector spending, so then entrepreneurs can come through and drive forward the growth that leads to better taxes, higher taxes, and better public spending.
Do you know what is embarrassing? I mean, I
got him going.
You got me on a rant. And, it touched me yesterday because my wife is Welsh, and I've got children who can identify as Welsh. And I know
I'm Welsh.
And CJ thinks he's Welsh. I know you're Scottish, so you got something to be. So you would have been annoyed that the Chancellor yesterday said that they're going to make 2 new AI growth zones. aimed at boosting the tech industry and creating jobs, specifically in South Wales, where they're going to spend, to be fair, £10 billion on a growth zone over the next 10 years. So let's average that £1 billion a year. And you're still, that's okay. They say that's going to create 5,000 new jobs, right? So that's 500 jobs a year. 500 jobs, okay, not to be sniffed at. But we've just lost 180,000 jobs in the past year as unemployment in this country has risen. What difference is 500 extra jobs going to do? And then to add, injury, she actually made a statement saying that the AI investments in Wales are going to be complemented by a 10 million, not billion, £10 million investment in semiconductor technology. I mean, it's embarrassing. It's absolutely embarrassing. NVIDIA sell more chips than that in sort of 3 seconds. It's ridiculous.
I think it's time to move on to the portfolio because we do have to remember we had the FTSE 250 for this event. So let's look at how the performance of the portfolio looks this week. If you remember, we had 2.5% allocation in the crypto and blockchain ETF, but we doubled that last Friday in the closing auction. Now, week on week, the ETF is only up 4.8%. However, from Friday night's close, it's up 14%. So that has given us a fantastic return there on the blockchain. And maybe, just maybe, we've managed to catch the lows. Russell 2000 was up 5.8% on the week. That's given us a nice, healthy return. But total return since inception, that only turns positive now, up 4.7. Then it was the NASDAQ 100 with a 5% gain on the week. A reminder, we also added to that last week to give us a total weighting in the portfolio of 7.5%. Now, Spice, what about the losers on the week?
It always falls to me to have to do the losers. Thanks, guys. Thank you very much. Well, India, which, if you remember, had been the best performer the week before when we had the big down week, gave a little bit back this week, down 1.6%. And then the emerging markets was down about 0.3, so unchanged really, as was cash. Emerging markets were still up about 4% since inception. So overall, a positive week. I think we're up 1.8%, which since inception leaves us 9% up.
And I think that's important to just emphasise that we talked about the Santa Rally last week. We've got a bit lucky because they've suddenly started talking about more rate cuts, which is tied in nicely. But at the end of the day, that's what Santa Rallies are for. So it was good timing, and we are, back up to 9%.
But after all this negativity I've been subjected to over the last half hour, what are we going to do with this FTSE 250? We had a specific catalyst and an event, and it hasn't panned out.
Yeah, I mean, the really disappointing piece is that we bought our 10% FTSE 250 because we felt it had a compelling valuation, very cheap, but there was a catalyst. And, I think it's important to explain to people that when you're buying into markets, you need a couple of things to be going your way. One of those is to have an attractive valuation. It might be an expensive valuation. You think it's going to go more expensive, but it's attractive to you. But there needs to be some sort of catalyst as to why it's going to work at that time. Otherwise, you get stuck in what's called value traps, which is where you say, I think this company is really cheap, I'm going to buy that, and it doesn't move for 5 years. I've got plenty of those in my portfolio. But, at the end of the day, you need two things, a catalyst and a valuation. So we got the valuation, and we put the money in because we felt there was going to be a catalyst. And, although yesterday, the more optimistic members of this team, Richard, have been trying to explain to me how this was good for UK equities and how telling the banks that they, needed to have a big campaign, people think will get everybody to buy UK equities. I think we have to admit that wasn't the reason why we bought it. We thought there was going to be something done on stamp duty. And therefore, we're in that really difficult position. And we're in a difficult position which many of our listeners would have been in, which is you bought something. It's gone down a little bit. I mean, it's not really moved. It's down 2.5%. It's not relevant, really, in that sense. You think it's cheap. You don't want to sell it. But the reasons for buying it have changed and gone away. Sounds a bit like what might be called a rabbit.
Okay.
And we know from our previous episodes that with rabbits, you should really shoot them. I really don't want to sell it because I think it's so cheap. And it could be there's a difference coming through. I'm torn a little bit by, discipline versus emotion. And we've sat here with Lee 2 weeks ago saying you've got to get emotion out of things.
And hope is not an investment
Hope
strategy.
is not investment strategy.
Because how do we feel if that's down 5% in the next week?
Very disappointed.
I think rather stupid.
I'd say a terrible decision, Spicy. Here's what I would say. So my temptation is we've got to do something. But first of all, on that point, guys, I mean, we've got FTSE as well, FTSE 100. You know, the FTSE 100 is really an international selection of companies moving in and I'm confident they will be performing well in the Santa Rally. The FTSE 250 is really about the UK, and that's really, you know, the important distinction here. So I don't think I would be tempted to do anything with the FTSE 100 ETF, but I think I'm going to have to be dragged kicking and screaming, but dragged to do something with the FTSE 250. What would I do with it?
You've hit the nail on the head. We bought it for a certain reason. It hasn't happened. You know, is there another potential catalyst around the corner that we could cling on to? Answer, no. Ordinarily, falling interest rates would also help this market, and we've already expected that, but it was expected before. So that's not a new catalyst, that's an existing catalyst. And I see no reason, because of the budget, for that to be accelerated or any other things to come through. You know, we're not going to get another budget for a year. That's a long time
Thank
in
God
markets.
Could there be an element people were holding back and waiting to get through the budget before they bought it?
There's undoubtedly been sellers of UK assets in the last 6-8 weeks ahead of the budget, with capital gains tax worries and everything. I mean, people were just selling UK assets. So there's clearly a relief rally. Now, the problem is people have been selling UK assets for the last 6 years. Every month for the last 6 years, all the numbers show people are selling UK assets. So yes, there might be some relief based on that, but it's not a catalyst to see it moving. I think, in fairness, if I'm going to be honest, I think last year, after the budget last year, the next month was the first time there was a positive month for UK equities for X years, and the next month turned negative and turned down. So that showed this evidence, that showed people have been doing this in the previous budget, selling beforehand to buy back in the budget. And maybe that buyback, maybe the fact it was up over 1.5% yesterday, was those people buying back in. But the problem is, it's just a cheap market. What is the catalyst for making it not cheap?
Okay, let's look at it from the other angle then. It's 10%. It's a big part of this portfolio, so it's a huge decision. Is there somewhere else you feel that it would be served better?
I'm broken record on this, but we had a debate about it just now. You know, the Americans are doing everything they can to try and get growth going in their economy. The natural beneficiaries of that are people being employed, getting wages, and companies and profits and share prices, therefore, ultimately. We don't have that. And I say they downgraded the growth expectations for the next for the rest of this year and early next year. And they've done nothing in the budget that we can identify here to do anything to stimulate that growth. We're at the whims of the global economy, and you know, outside of America, places are struggling.
The counter to that, we're starting to rehearse the breakfast discussion, but slightly in a more respectful manner, maybe, is Mark's absolutely right in what he says. No doubt about that at all. But it's already priced into the market. You've already got the US market trading at massive multiples, but the UK market trades at a very cheap multiple. And that's where this problem with value comes in, because value investors don't want to sell things that are cheap. They want to sell things that are expensive. But actually, a momentum investor is someone who buys things that are moving in the right direction. No matter how expensive they are, you keep buying them because it's got momentum. And momentum has been a fantastic strategy over the last 4 or 5 years. So the question to me is, I think we've got to sell something. I don't really want to go and put it all in the US, because the US is pretty expensive in my book. We've got a reasonable amount in there already, you remember. And so my gut instinct is to put a little bit in the US. I think we've got to do some of that, because the Santa Rally is definitely something that we expect to happen.
Yeah.
But would I put the whole lot in? I mean, the way I'm sort of thinking is selling 5% of the FTSE 250. You know, when in doubt, chicken out. So rather than selling the whole 10, I sell 5. Then at least I can say I didn't sell it all until maybe the week after. So, you know, if we were to sell half of it, I think I'd be comfortable putting half of that into one of the US indices.
So you're talking about selling 5, but putting 2.5 into a US.
Yeah, I think I've got to put some of that in there, because I'm with Mark. You know, we've got momentum there. It looks like the Santa Rally is going. Hold on to the reins over the reindeer. So we need to be absolutely G'd up for that. And I'm thinking, what do I do with that other 2.5? You know, I could put it in emerging markets. I could put it in Europe. I could put it in FTSE. I could put it in gold. I could put it in silver. I could put it in world mining or something like that. The reason I think more about equities is because I like the idea of the Santa Rally. I'm probably thinking more about FTSE 100, actually.
Thank the Lord for that, because I've spent £100 on getting hats printed with FTSE 10,000 when it was trading at 9,920.
Yeah, I do.
So,
I do. Perhaps we'll change that then. I'm thinking, and I can be swayed here, so guys, say what you think. But I think we've got to sell half the FTSE 250. I don't want to sell it. I hope I'm wrong. I hope I'm wrong to sell it. But I feel we've got to do that because we said we were buying it for a particular reason, and we've got to show discipline. And I would put 2.5%. I think I would probably put it in the S&P 500 because it's the benchmark index. If the Santa Rally is going to work, it's going to work there. And put 2.5% in the FTSE 100.
Well,
but what do you guys? Come on.
I was going to say, Spice has got his American flag wrapped around his shoulders and his pin on the lapel of the American flag. So why don't you have a go at choosing?
I mean, look, we definitely have to sell some of the mid 250. Yes, 5% or half of it is a good compromise, I think. But it is good discipline as well, as we've identified before. Personally, I'd put all of that into the US. I'd put 2.5 into NASDAQ and take that up to 10% and another 2.5 into S&P. Now, granted, we only added to the NASDAQ last week. We put another 2.5% into it. So I'm happy with the S&P 500 being our biggest position, which would add another, if you added 2.5% to that, would become 12.5%. So I would be happy with that. Do you know, I don't mind actually putting extra money in the FTSE 100 because I think if international investors take fright at the budget and do sort of start selling off gilt yields, then the pound will go down. And we've argued many times before that the pound going down, ironically, is good for the FTSE 100 because so much money comes in from overseas earnings for those big companies like Glaxo and BP and Shell. And their profits, therefore, should go up. And we should get to that 10,000. That's the holy grail of 10,000 on the FTSE 100, hopefully before Santa arrives.
As we know, I moved into the bull category, joined my right honourable friend here from last week. So,
Friends or friend?
the chairman is the chairman. There's no friend of mine.
Okay, sorry, yeah, all right. He's no friend of anybody's.
I'm happy with that. Look, the 2.5% in the US, that's fine. That's clearly, that is going to get bought into the end if the retail investors have anything to do with it, as they has over the past year. I've got my hat, so I'm happy to go FTSE 100. But one thing that we didn't mention this week was that BHP came back in for Anglo American, and they had bid talks last weekend. And then BHP hurriedly said, when they got a negative response, they said, "Oh no, we're not interested anymore." But that is clearly a positive signal for copper for 2026, 2027. And we've talked about it. We need to talk about it more. We've only got 5% of our money in copper. So somewhere I would like to consider at going into next year would be to increase that copper position from 5%. That's not this week's, because rightly thinking equities for the Santa Rally. However, I just wanted to mention that before it's forgotten in a few weeks' time, that copper could well be one to look at.
I'm with you on copper. I'm very bullish on it. I think that the fundamentals with this extra demand for energy and energy transmission that comes with the AI build out, I think is going to be very, very powerful, and copper is going to be probably one of the main beneficiaries in metal terms anyway.
Guys, it would be great if we actually could see, or actually did a bit of work rather, on how much copper exposure we've got within the portfolio, because we've got a 5% copper holding already through the ETF, and we have 10% in the BlackRock World Mining Trust. How much has that got in copper, guys?
So that's around 20% allocation. Remember, the majority of it, over 32%, is in precious metals. 20% of it is in copper. That's right.
There's a 2% there. So we're talking about 7% of the entire portfolio is already in copper.
Yeah.
I mean, certainly something to think about. There's no doubt. I'm not scared of doing that, but obviously it's very volatile as a holding, And so we've got to think about how it fits into our portfolio construction.
And interesting you bring that up, because we had a wonderful email in from a listener this week, didn't we, that looked at the risk overall of the individual portfolio and how it sits.
Yeah, I had an email from a very good friend of mine, and Peter broke down our portfolio for us. Now, I suspect he thought that we were giving wealth management a bad name because he wanted to see what our risk actually looked like. But he actually broke it all down as a professional would break down the risk into the volatility within the portfolio. And actually, what it comes out to say is that the portfolio that we have has a volatility very close to the FTSE 100 overall. So if we took our whole portfolio and put it in the FTSE 100, its return characteristics would be very similar to the one we've actually got. Now, clearly, we don't own FTSE. We're talking about its return volatility characteristics would be the same. And so that was quite an interesting thing to see. Now, in this document, it also showed the volatility of all our positions. And when I say volatility, it's a measure of how much they go up and down. That's what people need to understand by volatility.
And so is that a way to judge your risk of the portfolio then?
Yeah, that's exactly the way that we're looking at it. So what we want to look at is look at the volatility of each of these holdings. It gives us an idea of how much it could move up or down at any particular time. No one will be surprised, I hope, to look and see that the VanEck Crypto and Blockchain Innovators Fund is very volatile and is almost as volatile as Bitcoin. I mean, that's a very volatile holding. The second most volatile holding on our list is copper. And that's why I come back to what we just said. So we need to be thinking about, yes, the fact we want to own copper, but the more we have of it, the more volatile our overall performance will look. And so we need to be thinking very carefully. This will be a subject of a podcast in the new year, how we look at the risk on the portfolio. But we've got to think about how risky each of these holdings is when we bring them all together. So, Peter, thank you so much for that. Keep it coming.
Thanks, Cobby.
Another email we've had this week is a great question from Gabrielle. With your portfolio performing extremely well recently, well done, Chairman, sir, joining at this stage, right? So he's thinking about investing alongside. And just a reminder, if you want to look more at the portfolio and see its performance during the week, it is available on the IG platform under watch lists, the Art of Investing podcast under watch lists. So joining at this stage makes me a little bit nervous about investing at the current all-time highs, particularly in areas such as gold and the NASDAQ. However, given my long-term horizon is 20 years plus, does it really matter what the price is now? CJ, what do you think?
It's a real challenge to answer that question, because if you remember back to 2 weeks ago when Lee was here, we were talking about the types of investors and what is important when you invest. And one of the things that he said, it was reiterated in the Deutsche Bank Research Institute's piece that I talked about last week, is that location of a trade is important.
The entry price.
So, and by that, I mean the entry price. Absolutely right. Thank you, Richard. So the entry price is important. That would mean then I'm never going to buy an all-time high, because that would be a silly thing to do. However, we also know from previous interviewees, when Charles Hall came in right at the start of our podcast series talking about UK equities and things like that, he made it clear that you should expect to see equities trade at all-time highs because earnings are going up over time, so therefore share prices should go up. So you've got these two contradictory ways of looking at things. So my answer to that question would be, if you are looking seriously out 20 plus years, you shouldn't really care about buying it now, because over time, we've shown all the evidence on the podcast of how assets have returned. You will do fine. The difficulty comes if something is really highly rated now and is at an all-time high. So if someone told me, and of course I would say this, FTSE 250 or FTSE 100 or the DAX or something, would I be worried about them trading high? The answer would be no, because they're not highly rated equity markets anyway. So the chance of that being a high for a long time is very unlikely. It is more difficult when something is rated at a much higher level to be able to say that you won't have a setback before it then runs and takes out the high again. So, sorry, I'm sort of hedging my bets here. I would say, don't worry about it. Buy in if you've got a 20-year time horizon. That's the right thing to do, and that's what I would do in that position.
What about our king of momentum? You've bought a few all-time highs in your time, haven't you, Spice?
Yes, and hopefully a few more. I don't really fear, Frank, maybe naively, the all-time highs, because as Chris said, equities naturally should be pushing higher, not just because earnings are improving, but if you believe like me that we're going into this AI-led era of potentially greater profitability, greater efficiency, and then all the stimulus that comes from the one big beautiful bill and tax cuts, etc., that I expect the US markets to be making all-time highs again very soon and to continue to push on. I've always said that I believe that you need a catalyst to end a bull market. They don't die of old age. Something comes along and maybe you see it after the event, but something normally happens to sort of end a big bull run in markets. By its very nature, you can't see it until it's probably happened. But from where we sit now, I can't see anything that could push that off the cliff. And therefore, yes, I'd happily shut my eyes and keep buying it.
So the answer to the question essentially is, don't get put off by the fact we're at all-time highs. Go out there, close your eyes and buy it.
Great stuff. Thank you, gents. And if you have sent in an email, then just please bear with us because we've had a couple of guests in the last couple of weeks and then the budget to get through today as well. But we certainly are taking notice of them. And over the next few weeks, we're going to make every effort to answer 2 or 3 questions at the end of the podcast as well. So keep them coming in. Gentlemen, to which email address?
The art of investing at IG.com.
And if you like what you've heard today, please give us a like and subscribe just below the podcast. If you really like what you've heard and you're coming back week after week, then don't forget, this is your last chance to vote for us in the Good Money Guide in the category under Best Financial Podcast. This is the last few days before the votes close. That would be very good of you. And thank you for joining us. We'll see you next week.
Stocks go up a bit. The dollar goes down a lot, though. It's Wednesday, December 3rd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. He's Ilya Spivak in San Francisco, here to take you through the next 25 and a half minutes as we wind down this trading day here. It was a fairly unremarkable session by a large extent. Mag 7 names churning, struggling. Microsoft potentially missing AI sales quotas. Other than that, though, the breadth was fantastic. 3 sector ETFs down, two of which are related to gold and one's utilities. That's nice. Nice enough to be led by the Russell, which is your top performer. The banks are the ones that are moving on up. Stability in the treasury market, stability in the metals, mostly a story of later on in the show. Bitcoin, Ethereum, they continue to bounce back. So there's some stability in MicroStrategy as well. Russia, Ukraine, US, Venezuela, are those related stories? The energy market seems to think so. Natural gas is up with the cold polar vortex coming in. But my concern is with the dollar today, Ilya, because that looks like a bunch of dirt. And while we've talked a lot of stocks here with Nick on last call, we didn't have much of a chance to go into the global macro sense of things, Ilya. So I do want to start here. What the hey is going on with this US dollar? Because it's the thing that is hurting me the most today.
It is by far the thing that's hurting me the most today. And thankfully, it hasn't crossed any Rubicons yet. But there was a really interesting set of PMI numbers that came out overnight, covering most of the world's major economies. Of course, the ones out of China were doo-doo, as per the usual. The economy over there continues to unravel. We had the official numbers earlier in the week. They were even worse than these S&P global numbers. If you're a fan of watching the economic data, you'll be, I think, somewhat tickled that the sponsor for the S&P China numbers is now no longer Caixin, which is a media organization that had been the sponsor for years and years and years. 20 years, I want to say. As far as I know, that's as long as I've watched it. Now it's a company called Rating Dog. So we get Rating Dog PMI. It's fantastic. I digress. Aside from China, the European numbers were much better than expected. And so we had a massive rally in the euro and especially a massive rally in the pound. The pound was very heavy, really, for weeks. The euro was outperforming it. In fact, if we take a look at the spot EUR GBP symbol here on the chart, which we can do now with our handy inclusion of spot in the platform, we can see the pound sharply outperforming today after a long period of underperforming. And that's really around those PMI numbers were looking much better. Now, they weren't looking strong per se, but they were positive in terms of growth, and they were meaningfully better than expected across the board. Meanwhile, the US set of numbers was meaningfully worse. The revision for S&P global PMIs for this latest round in the US actually saw a revision lower, weaker growth. So all of that seemed to conspire to sting the dollar here and sort of give the sense that the pound isn't going to be hamstrung by its own rate cuts anytime soon. Neither is the euro. In fact, inflation data out of the euro area on Monday this week was a little bit stronger than expected. So you have this really clear-cut kind of yield story for the dollar here today, where the major counterparts look like they have a yield advantage. And not surprisingly, yields down today, down at the 10-year, down at the 2-year, and with some vigor, through 0.75% down on the 10-year, almost 0.7% down on the 2-year. Rate cut odds haven't moved terribly. We're to 89% on a cut for next week.
We're through that. We're past 100% with the SR3s.
Yeah,
there's a little bit of a gap there.
Yeah. So Fed funds, and of course there is, because SR3s are 3-month contracts. Fed funds futures are 1-month contracts, and the outlook for next year, which this SR3 contract would catch, because it is a 3-month contract, that is much more dovish still than the Fed has owned up to. So there seems to be an expectation here that what you're going to see next year is going to be a lot more dovish than what the Fed wrote down in the September summary of economic projections, and that maybe they're going to write down more in this December update. The ADP number was not good at all. It was a 32K decline against expectations for a 10K rise. ADP is not the world's greatest indicator of how the labor market is actually doing, but in the absence of NFP, it is a yardstick the markets will take. And ostensibly so will the Fed. The ISM numbers were only a touch better than expected at the headline, call it essentially in line, but another contraction in employment in the service sector on display there. That would be the follow-on to Monday's ISM numbers, which showed yet another contraction in employment in manufacturing. In fact, in the manufacturing report, that was the fastest contraction for the sector since July, and the fastest contraction in employment since August, narrowly, for the services sector, which we got today. This was a little bit of a slower contraction in labor than the prior month, but also the sixth consecutive month of shrinking employment in the sector that employs 80% of America. So not good news. And although inflation cooled a little bit in the service sector, it accelerated in manufacturing, and on both counts, they are still very elevated relative to history. The move higher in price levels, in input prices and output for both sectors, that's now been ongoing basically since the end of 2022, of course, when everything bottomed after the Fed cutting cycle. But the surge that we started to get at the beginning of this year with the introduction of the tariffs, that's still very much there. It's moderated some, but only a little. And so you get this really ugly stagflationary message in the ISM data again, which, not surprisingly, comports again to the Fed's going to cut. They might cut more than they've owned up to so far. The markets now have 64 basis points for next year against the Fed's 25, whereas Europe isn't. And so you get this rate differential that hurts the dollar, that lifts gold, that gives you the rally in the bonds.
What do you make of the fact that the Russell's up almost 10% from its lows 2 weeks ago?
The banks, KRE, they loves the rate cuts. These are regional banks. We know, obviously, that this is particularly sensitive to lower interest rates because all of them are still sitting at various stages of Silicon Valley bankness, right? All of them are sitting on giant piles of U.S. government debt, which is incredibly underwater since the 2022 rate hike cycle. And they're all sitting there just praying that there's not a bank run where they have to liquidate some of their hold to maturity U.S. government debt portfolios at steep losses. They can't get these rate cuts soon enough so that they can feel themselves getting out from under the weight of what is essentially a ticking time bomb that only rate cuts can diffuse. So, not surprisingly, ever since that SVB episode, we have had this ultra sensitivity from KRE to rate cut expectations. And of course, that's a huge subset of the Russell. So, in so much as we're focused on rate cuts today, I'm not surprised at all that the Russell is doing as well as it is.
Russell, to me, is starting to look really bullish. And I'm remiss that I have any semblance of short deltas on in here. But when I look at KRE being a backbone to that, right? The banks are so important to everything else that goes on. If the banks are healthy, then you're not too worried about recession at the end of the day.
I'm not sure that that's true anymore.
Well, historically speaking,
it used to be.
recessions aren't caused by declines in consumption activity. They're caused by declines in business investment activity. So if loan growth, loan origination, debt servicing, all of that is, in a good place, in a healthy spot, then everything that we're hearing and we're discussing is a lot of noise, but the economy is just kind of humming along.
I'm just not sure that all of that loan origination still happens in the banks. If you take a look at where the preponderance of lending has happened, it's happened from non-bank institutions. I mean, just take a look at how Blackstone is doing. Take a look at how Apollo is doing. Take a look at how KKR is doing. They are all looking much, much weaker than index averages this year. I think Blackstone is really the BX is the ticker there. I think that's the one that's probably the biggest player in this non-bank lending space. They're certainly competing to be the largest. Apollo as well. I mean, they look absolutely awful. And look how sharply they are up today, again, because they are not unlike what's happening in KRE, very sensitive to borrowing costs now that they've gorged on all of this lending. So I don't think you can really say anymore that, oh, well, as long as the banks are not in an '08 kind of space, or even something more moderate, that we can feel okay, because I don't think they've been the big lenders into the run-up over the past several years. It's been more these non-bank names that have fed most of the capital, and the market has figured out since the beginning of the year that that's an issue.
If this is a chart that's going to move up, I love the symmetrical triangle. This is a weekly chart now, so this is our
technically it looks very compelling if there's a break.
I mean, if there's a break to the upside, but then if KRE is going, then you're looking at the Russell then going, right? And
I actually might start looking at some of these non-bank things that have been so beaten up. Obviously, you're seeing them rally today.
Russell looks fantastic. Closing. Like, how technically clean is this? Downtrend, get out of the downtrend, clear out the cycle highs, trade through, return back into them, form a resistance, turn support, immediately bounce up. It's super clean. And like that to me, get rid of everything else.
But it's clean.
Chips on the table, like 25.60 seems like, another test of the yearly high, path of least resistance. If you told me, more likely to test the yearly high or not by the end of the year, looking at this chart, I'd say we probably have another.
Yes,
we probably have another shot at it.
Yeah, I mean, I'd say the answer is yes. Looking at it here now, again, would I be a buyer of this? No. Would I be a seller of it? No.
Oh, well, I'm a buyer of it. I sprinkled in a whole bunch of different things today into the follow account, including a new Madman trade. But long deltas in Apple, AMD, Corning, GLW, Snow. I did not get filled on Micron. That's a bummer. And then Warner Brothers Discovery, because Warner Brothers Discovery is currently fielding offers to sell itself. And there's a little rumor going around the world right now that Netflix has a all-cash offer for $30 out there. The bidding process should be wrapped up before January 1st. So why not? In the typical Madman fashion at 44 GTE, looking at a $30 call. They were trading at 9 cents before. So now they're trading at 15 here after hours. But max loss on a 10 lot is $90. Max gain is around $2,000. Put it here in the Tasty Follow account. It's all public information, so we actually need a bid to go through. But if it were to go through, then maybe this thing snaps up to 30, and that's that. But it's just an idea. It's just something to play with, because I look at this S&P 500 chart today, and I said to myself, here's the downtrend. Here's us fighting to get through it. Here's us poking above it. We're not quite there on the daily time frame, but this is a lot of nice former resistance, basing above that, becoming support, pushing through. It feels very similar. It feels familiar, this price action, where we wash out, we then snap back with our V recovery, and then we do our stair stepping up in low volume with positive technical drift.
That could be how this is going. I am certainly not close-minded to that idea, because that could certainly be the way that this develops. Because I'm sort of balancing having 18 days to expiration on my puts, and because those puts are still in profit narrowly, because I'm short from October 29th, day of. So I have to balance, okay, what do I do here? Do I wait to roll? Do I roll now? Do I take my money and run? What is there to do here? For today, I think I'm waiting. We're going to see what happens tomorrow. I think we're through much of the key data at this point. We are going to get a very, very stale PCE report on Friday. We're also going to get revised consumer confidence numbers. We'll see if that does anything. But for the most part, we are now in Fed anticipation mode. And so I wonder what happens now tomorrow, now that all the data that really matters, such as there is data, is out of the way. What happens when the markets just go to let's reposition for the Fed mode? And what does that mean?
That was what I was just saying to Nick. We're like, it wouldn't shock me if the next few days, he was asking me in the context of how are you getting ready for next week? And it's like, quite frankly, I'm not really thinking about next week's Fed meeting yet. You probably have a few days here, and then you go into Friday, maybe people start peeling some stuff off. And then, Monday to Tuesday, you get a little bit more downside if people are really jittery heading into it. But
yeah,
also, I don't think Powell disappoints.
The cut's coming, I think. I'm not sure that's the issue anymore.
We have been trained on this. The idea that the Fed does not like to disappoint the market. And right now the market's pricing in a 90% chance of a cut. Ilya, how many times have you heard this come from my mouth? Over the past 30 years, anytime the market's priced in greater than a 55% chance of a cut, the Fed has delivered that cut
on the eve of
the time,
which is important.
Yeah,
because obviously it's oscillated a lot.
Well, it's 7 days before Santa comes. I mean, Powell comes, so we're getting pretty close to FOMC Eve.
Yeah, no, I think you're right. I think at this stage we're getting the cut.
Do you know how?
I don't think that's the question.
Powell would break the Fed and the market's reaction function to the Fed if we're at 90% odds next Wednesday and he doesn't cut. It's going to be something that has never occurred in most professional traders' lifetimes. And it's going to fundamentally change how the market views using things like the SR3 and the ZQ as a predictive, like, oh, market's pricing in an 80% chance the Fed's definitely cutting. That won't mean anything anymore.
Right. What? I don't think it won't mean anything. I think it will still mean quite a lot, because it will tell you what the markets think the appropriate policy is. And I think it's also really important to remember the Fed and the market are at odds all the time, and the Fed usually bends the markets to its will, not the other way around. The markets don't typically get their way when they start to speculate too far out and too crazily. What we're talking about here isn't, oh, well, if the markets have it, almost certain the Fed does what the markets say. No, that's not really what we're saying. What we're saying is, on a given meeting, when the markets have been primed successfully by Fed officials, which go to great lengths to prime the markets, by the time you're a few weeks out from any given meeting for what is about to happen. And the Fed is very good at this, ostensibly better than any other central bank. And you you really, I think, have to tip the hat to Ben Bernanke that really launched this sort of transparent communication as a stabilizing force during the 08-09 crisis. The Fed is really good at letting the markets know what it's going to do at any given meeting, such that if the markets have conviction, that's probably because the Fed has successfully talked them to where they need to go. But disconnects, let's say over a 6-month window, tend to resolve in the Fed's direction because the markets tend to over speculate and overshoot, as they are wont to do. And the Fed has a much longer view. And so its reaction function to data is different. Its way of kind of pacing itself is different. So we're not saying that the markets dictate to the Fed. No, most of the time the Fed dictates to the markets. But the Fed does it in 6-month intervals, maybe 4-month intervals when things are jumping. When the markets are this certain that the cut is coming, it's almost certainly coming. The larger issue is what happens next year, because there is still a gap of at least one, closer to 2 cuts. So if the summary of economic projections this time ends up being the casualty of the give and take on the FOMC, if the bargain that is struck with Stephen Mirren and them, and by and them I mean people like Chris Waller say that favor a cut, if the balance is struck that, look, here's your cut, there you go, fine, but we are not going to change the summary of economic projections because we're, in Powell's parlance, stuck in the fog and we can't see, the market is going to be very disappointed. And that's probably more important here than the cut itself.
Well, something for the bears here. Microsoft's chart looks pretty crappy, Ilya.
It does.
You have that September swing low here. You have the early November swing low.
Also technically very clean, just in the opposite direction.
Yeah, and that's what's really interesting about this market here today, because I look around the board and I see something like an RSP, and that clocks its 3rd highest close ever, right? This is not that far from hitting a new all-time high. You have QQEW up 1.08%. It's been a straight line higher over the last week. Strong breadth. The banks are doing well. The semiconductors have really reemerged above that uptrend from the April and September swing lows cleanly at this point in time. It wasn't like, where we were on Friday last week. Oh, can we zoom in? Can we zoom in to see if it's above? Oh, it's above there. No, this is a clean break above the trend line at this point in time, and it's continuing to ride its 1-week moving average. So the market, we've talked about this. I
wholly encourage continued Trump imitating on the zooming in.
That wasn't Trump. That was
now and forevermore.
No. That was more like Larry David. I've seen all these posts on Reddit recently about earthquakes in my area, and I'm pretty sure we're just having an earthquake here right now.
Uh-oh.
There's also been a lot of military helicopters overhead today, like several Chinooks, which is odd because we don't have a military base that close by. And they're heading northwest towards West Point, I assume. I digress. Ilya, around the horn, XLI, for example, in industry, right? Mm-hmm. Pumping up here 2 highs today. You could look at ITB. You could look at, go to home builders, XHB. That's now closing at a new high relative to where it closed at the end of November. So just a general jaunt around the sectors tells me that things are starting to feel a little bit better. Not everything has turned the corner, but there's enough there right now where that whole adage of folks have been so offsides for most of this year, not being short into April, then selling out in early April, then being in this chase mode all year long. If you look at the scoreboard for how multi-strat hedge funds or any of these large asset managers have done that play in the world of stocks and bonds and crypto and currencies and precious metals and energy, what have you,
Yeah.
No matter what the benchmark is, they're basically all underperforming it. And it's a bull market. And as long as you've known me, I like to say the little smug, obnoxious thing, can't lose money in a bull market. And it's very much that situation right now. So
allow me to retort. You absolutely can.
Okay, but you shouldn't, is the point. You shouldn't be
Thank you,
losing money.
US dollar, for preventing me from losing money in aggregate, despite my ongoing naysaying of the stock market.
68.62. That's where the S&P 500 closes today. NASDAQ 25,641. And with that, overtime is out of time for this Wednesday, December 3rd. We'll be back later tomorrow. Of course, tomorrow. It's Thursday. And we're here every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya, I've been Chris. See you later. Stick around, though. More Mr. Spivak with Macro Money up next here on Tasty Live.
See you there, everybody. We're getting the rate cuts. That's the message from the markets today. Tepid though it is as far as the response in stocks, but the dollar is shellacked. So we are going to try to figure out what all is going on here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And as ever, we'll start with what the price action seems to be saying here about what these markets thought today and how they're setting up from here, because we're through the big batch of economic data this week, such as there is economic data. Obviously, we're still very hamstrung by the aftermath of that government shutdown, but nevertheless, so there is some third-party data, some private sector data that we had to look at this week, and now most of it is out of the way. So we begin waiting for the Fed mode. The Fed, of course, gathering next week. The 10th is when we're going to get that announcement next Wednesday. So let's break down what the markets think they know here and why they think this is, for the most part, a good thing. Whether that's really how this will shake out. So another tepid gain for the S&P and the NASDAQ today. Relatively moderate, but nevertheless, we do end up on the upside. Looking at the charts here will show you that we're looking at basically a range that has held up, and incidentally on the close here, these gains were somewhat moderated. I took this screenshot right as the markets had closed, but of course there's the after hours digestion that we get, and looks like the gain in the S&P was 0.34% gain, in the NASDAQ 0.15, so even a little bit more modest than what we have here. Yields go down significantly, off 0.76%, almost, let's say give or take 0.75% for the 10-year, almost 0.7% for the 2-year. So the whole curve shifts lower. Crude oil up, gold up, euro up, yen up, Bitcoin up, and up meaningfully enough that we can say it's doing the risk appetite on steroids thing as relative to stocks. So stocks go up, Bitcoin goes up more because it is a less liquid, more speculative reflection of the same risk appetite that seems to be making its way through the stock market here today. What precipitated this? Why are we looking at this picture, which seems to be uniformly of one flavor? That is to say, interest rates in the US lower, dollar lower with them, those things dependent on those narratives uniformly responding. So commodities priced in dollars, higher. Currencies not named the US dollar, higher. Alternatives to the dollar, Bitcoin, higher. Speculative appetite, firmer. Moderately firmer, but firmer. So what is in the offing here? Well, first we get the final results for November's S&P Global PMI numbers that give us a sense of global growth. And the big standouts end up being the European numbers because there's actually significant revisions here. The Eurozone composite stronger than expected, 52.8. The UK composite stronger than expected, 51.2 against expectations of 50.5. Now, as ever, these are in the logic of the PMI math as usual. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see for all the major economies, we're above 50 here. So the global economy is growing. And we'll get to China, of course, in just a second, because that might be something of an exception. But for the most part, the major economies here, Eurozone, growing. Europe, including the UK, growing. But growth in the US slower than initially reported. The first look at these November PMI numbers had us going from 54.6 to 54.8, so accelerating. Actually, turns out we're revised to 54.2. So what's interesting here is, first of all, we're diverging in a direction where the US looks weaker than Europe as far as growth dynamics are concerned. Now, the US is still growing stronger in absolute terms, 54, of course, higher than 51 or 53 almost for Europe. And of course, these are not going to be exactly like for like, but the US certainly still looks like it's growing stronger than Europe in absolute terms. But the path of travel has diverged in Europe's direction in these numbers. Now, that's interesting, of course, because we're not really looking for any more rate cuts out of the ECB all through next year. And the situation in the UK is somewhat circumspect as well, because they have quite an inflation issue there. And so what we're looking at for next year is 2 cuts out of the UK at this point, 41 basis points on the menu for SONIA futures, the equivalent of Fed funds futures for the UK. And that's not nothing. That's something like 1 cut at least and about a 50-50 shot at a second. But if we look at how that compares with the outlook after this data here today for the Fed, and indeed where the Fed outlook has stood for a while here, this is the view for 2026, 64 basis points. And that only gets more dovish today. Because if we take a look at what the level of conviction is on December's move, it's only very modestly stronger today. We're at about 89% chance that we're going to get a cut next week, up from 88% yesterday. So hardly any change at all. And a week ago, we were, of course, already north of 80%. So looking at this a week ago, we were looking at 83.5 or so percent. So a month ago, it was a little bit hairier, 66%, 67%. And of course, in that intervening month, from early November through to recently, there was a switch there where Fed policy expectations went to 50-50. That was after Powell's explosive naysaying of rate cut inevitability on October the 29th when the Fed last met. And there was a slide there from over 90% likelihood that you would have a cut in December down to 60-ish, which is what we're seeing here. And then further commentary took it as low as about a 50-50 split. And at one point, actually, a cut looked less likely than standstill by a narrow margin. And of course, what we know of that is that the markets didn't like it and that the dollar generally held up through it. Because, of course, fewer rate cuts is a good story for the dollar's yield differential position. But what we get here today is a very different kind of a thing. We clearly get a sense that at least U.S. relative to Europe, we're looking more dovish in the U.S. now relative to expectations than elsewhere. Now, I mentioned China here. We get this private sector estimate. By the way, it says Rating Dog. That's the new sponsor of the S&P Global's China report. It used to be Caixin. Now it's Rating Dog. But they're still the same S&P Global numbers. For example, in Europe, you can see the sponsor is HCOB. And so when you look at those numbers, they look like nominal growth, 51.2, but that's, of course, down from the prior month of 51.8. And we did get the government's official numbers earlier over the weekend. And both the Rating Dog numbers, which is this in the blue and tends to run a little hotter than the official numbers, and the government's own numbers from CFLP, the China Federation for Logistics and Purchasing, that's essentially an arm of the government. We have this parallel slowdown in China growth dynamics since September, and at least on the official figures, we're in contraction mode. China's economy is shrinking, according to official figures, or at least economic activity in services and manufacturing together is shrinking. The Caixin, or the Rating Dog, former Caixin numbers don't quite show that, but the direction we can see is the same. So for China, the situation still looks dire, but of course they've been in economy-wide deflation going on over 2 years now. And so we're looking at an economy that's basically been hamstrung since before it exited COVID lockdowns and has never really found its legs again. And that continues. But at least as far as Europe is concerned, there is now this appearance of maybe, at least from the dollar's perspective, Europe is trying to take the initiative. Those currencies are trying to take the initiative. Looking at what this looks like for S&P Global U.S. numbers, though, it's not by any stretch a scary story. We're still hovering at a familiar range for overall growth here. And this range generally lines up with the levels that were there in the second half of last year, which, by the way, were multi-year highs, and were there ahead of the tariff scare at the beginning of this year that really took the PMIs sharply lower as people were concerned that they were going to derail the economy. It had to be that on contact with the president's Liberation Day ideas, the markets got, in his parlance, a little yippy. That is to say, the markets dumped the dollar, dumped U.S. stocks, and dumped bonds at the same time for the administration to come back and put a 90-day pause on everything and then extend that pause where needed to make sure that the actual Liberation Day ideas that the president put forth don't see the light of day in practice, that they essentially end up being an opening bid on negotiations. And once that started to crystallize. Of course, first we had the rebound in stock markets. April 7th, 8th, and 9th is where you get that bottom forming, and then you have a rude rally, largely around the idea that this scare has been put in the rear view, as it were, because the administration would not earnestly push it in all of its damaging aspects. We also got the ISM report, and the service sector numbers came in a touch stronger than expected. 52.6 versus 52.1 expected. That's not really a big departure from where we expected to be. So this is borderline in line with expectations. But when we look at the internals, we see that, especially the Fed relevant bits, employment and inflation, that stagflationary fear that people had in that intervening period from mid-February, let's say, until early April, through the meat of the scare around the tariffs, that stagflationary fear is being realized, albeit very slowly. So we're looking at ongoing contraction in employment for both manufacturing and services. You can see here's that 50 line. The ISM numbers working on the same kind of logic as PMIs generally. So 50 is the center, above 50 growth, below 50 contraction. We can see employment for both sectors is below 50, and that is, it is contracting and has been for a few months now. In the case of manufacturing, it's been contracting all year. While the prices structure has cooled a little, but still looks very elevated. Here's the beginning of the year here. As you get the tariff scare, you've shed a lot of that scare on the manufacturing side. You've not really made a big dent on the service sector side, although you get a decent dip in this most recent set of data. But you still have a situation where growth in employment appears to be souring, but the price structure appears to be still relatively heady. Now, from the Fed's perspective, they, of course, have been looking at this. And the message that we got in September and again in October is that these are maintenance cuts that we're seeing designed to backstop what's going on right here. And to that end, we got the ADP gauge of private sector payrolls here with a 32K decline in private sector jobs in November against expectations for a very meager 10K rise. So we're looking at a situation here where ostensibly the Fed's logic for a rate cut holds and policy expectations reflect as such. But as we just said, this isn't really materially different from where it was a week ago, from where it was even very recently. And so this is, for the most part, seemingly priced in. What isn't priced in is, once again, this picture, because not priced in the sense that the markets and the Fed are still very much at odds. Now, one of them is going to have to shift. Maybe it's the Fed. Because when we look at September's summary of economic projections, what we find is that the Fed only has one rate cut on the menu for next year, from 3.6, which would be 3 cuts this year, as now the markets wholly expect is going to be realized. And from 3.6 to 3.4, that's rounded up 1 cut. And what the markets have is 64 basis points, which is at least 2 cuts. That would be 50 basis points, and 14 basis points in the direction of a third one, which amount to better than 50-50 odds that we are going to get that third cut. In fact, 56 6% chance to be exact. And that, of course, is at least a cut, maybe 2 cuts off from where the Fed is. And so the risk at this point, where the Fed might well disappoint the markets, isn't in the cut that's coming almost assuredly next week. It is in what they write down in the new summary of economic projections. And the bargain between the two sides of the committee, we of course have heard now repeatedly, including from the FOMC minutes from October, that there is a vast chasm on the committee and a vigorous debate as to whether it makes sense to press on with easing in the absence of critical economic data and thereby in the absence of visibility into the economy and what's actually needed for policy. And so you get the camp that thinks, okay, we'll cut in December, but we need to be very slow going and take it meeting by meeting and not overpromise, because we might underdeliver if inflation gets haywire, and then the markets are going to freak out. And then there's the camp, we'll lovingly call it the Stephen Mirren camp, which has never met a rate cut that they didn't like. And that, to some extent, of course, reflects the consensus of the administration. Stephen Mirren, after all, basically on loan as a Fed governor, having been the chairman of the Council of Economic Advisors to the president, and never left that role, despite the supposed respect that the administration has and that Stephen Mirren has for Fed independence. He's essentially on a leave of absence from the White House, and it tends to return. So make of that what you will, but that dovish camp clearly wants this third cut at minimum. And so maybe what the bargain ends up looking like, because the Fed is, after all, a consensus-driven organization, people vote. The chairman doesn't get to just decide things. Maybe the consensus ends up being, look, here's your cut for December, but we're not moving the summary of economic projections. We're leaving it at 1 cut. And we'll update it as need be. If that ends up being what we see, the markets aren't going to like it, most likely. And we see here that since that October 29th meeting, where Chair Powell so forcefully pushed against the inevitability of incoming cuts, that's where stocks top and come down. They've since rebounded to basically the starting line here, to where that move occurred, a little bit lower than the high, but just after this digestive period where the markets took on the Fed and tech earnings and then decided they don't care so much about the tech earnings, they care about the Fed, and resolved lower. We've basically returned back to that level here, and we're waiting for the Fed announcement. Clearly, the markets want the easing. If the promise of easing doesn't come, they may well resolve back down again. For the dollar, we can see this has been a rough ride since we've stopped this adjustment post-Fed meeting, and it's corrected meaningfully lower. It's not unlikely that risk sentiment firming up has been a part of this move. But again, if it looks like the Fed is more reluctant to cut next year than the markets think they ought to be, we probably get a forceful dollar rebound. As far as positioning is concerned, I haven't changed very much here in my exposure. Still long gold. That's working. Clearly, the dollar isn't working today. I'm still long the dollar via being short the Aussie, the pound, and the euro. Obviously, all of those currencies having strong gains today. So that's in the minus column for me today. But I'm still holding those positions. I don't think we've crossed any red lines here. And so we'll see what happens in the run up to the Fed. Bitcoin up today. I'm still a little bit short here, having taken the bulk of the position off early in the week, but we'll see what happens from here. At this point, the sort of risk on, risk off dynamic has basically become will they, won't they dynamic on Fed dovishness. And ultimately, if the perspective is that the Fed might not arrive at where the markets want it to arrive, you probably resolve lower on risk and higher on the dollar. And since that is what I'm suspecting here, I'm long the dollar. I'm still short risk, so still short a bit of Bitcoin. Still have the puts in S&P. They're still moderately in profit against all odds because I took them on Fed Day, October the 29th. So I'm holding on to this to see if this is going to ultimately extrapolate further lower. Still long a bit of silver and long the bonds, which is working today. Still a little bit short crude, which basically is just oscillating at this point. The trend has been down, but today is an up day, and I've got 16 days to expiration to figure out whether I want to keep this thing or not, and we shall see. And besides that, still have my longer term exposure to Brazil, where I've took profit on half earlier in the week and now have added back in, and MSOS on the possibility. This is a very long term position, obviously, looking all the way out to January of 2027, for the possibility that cannabis descheduling comes up in the midterms next year. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.
Crypto bounces back. Is that good news for stocks? It's still Tuesday, December 2nd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, here to take you through the next 28 minutes as we wind down this trading day. Stocks had a nice little bounce here this session, led higher by the NASDAQ as tech semiconductors rally once again. The breadth isn't fantastic. Not many sector ETFs are up on the day, but perhaps a green light for risk is given by crypto, which a sizable bounce here for Ethereum up over 8%, Bitcoin over 6%. Not quite the rallies we had earlier in the session, but still quite strong. Overall, you're looking at gold, silver pulling back in slightly given some of the recent moves to the upside. I don't think that's a surprise there. Ilya, maybe people were selling their gold and silver to buy some crypto today. In other news, bonds there stabilized somewhat. Not great news.
Yes.
Same thing for the dollar, a little bit more stability, but not necessarily great news. Energy's a touch softer. Tomorrow we have ISM services data, Ilya. We have a lot to talk about here. So let's break it down right now. NASDAQ is on our screen. It's our point of interest. Bitcoin bounces back above 90K. Tech rallies is the breaking news headline on CNBC.com right now.
Indeed.
Is crypto the most important thing in this market in terms of sentiment right now?
It's tough to say because where has it really gone? It's erased its sell-off at the start of this week. It's basically in a range and has been in one really since the beginning of last week. I'll tell you this much. I'm really happy to have taken half of my short position off yesterday and booked it. I haven't added back in at this point. I'm going to see if this range top holds. Crypto is certainly this sort of on again, off again barometer for risk appetite. And if you look at what the NASDAQ did today, it's ultimately a lot more impressive than crypto. I mean, sure, in percentage terms, the crypto move is larger, but of course it is. It's a illiquid, highly speculative digital tulip of an asset. Don't get me started. But the sort of magnitude swing here aside, if you look at how well-founded the positioning now looks in NASDAQ and the progress it's made, it looks a lot more impressive than does crypto in this sort of Bitcoin avatar in its guise. I think when you look at a day like today, it does sort of seem encouraging to say this is a sentiment thing. But if it is a sentiment thing, I'm not sure it's saying much about sentiment that is terribly supportive. If crypto had broken out, if it had cleared the top of its range, that would look like an impressive signal. I don't think we have that here. So I don't think that in the absence of other news, we didn't really get anything today. The big data is tomorrow. All we had to kind of think about today was a European CPI number, which isn't much. So with that, if this is just sentiment evening out from yesterday's kind of comeback day after the holiday, you look at ES as a kind of barometer of overall market sentiment, and you've gone nowhere. In fact, you've gone nowhere for a while here. So I'm not sure you take this crypto rally as a sign that anything is particularly steadier, more like things are oscillating and sentiment is waiting for its cues.
I'm thinking a lot about what's happening with MicroStrategy here right now,
Yeah.
Ilya, just because of how it seems to be the tail wagging the Bitcoin dog. It had a 5.7% rally here today, but that's not before like the 12% drop that we had yesterday. So you're in this weird place right now where they're sitting on 650,000 Bitcoin worth roughly somewhere between $55 to $60 billion, depending upon where Bitcoin's trading that day. The market cap is sitting 45 to 50 billion. So the market cap of the company, including the entire 8.2 billion in debt they've piled up to build this Bitcoin war chest, the net number is still that MicroStrategy's net Bitcoin holdings are still like somewhere in the neighborhood of $2 billion above its market cap right now.
Sure.
So you get this weird thing that's going on, whereas Bitcoin declines, people think that the Bitcoin selling is going to have to transpire. And, what's the point of holding MicroStrategy? Then if the flywheel isn't producing ever upward moving price movements, maybe that's stopped here today, ever so temporarily. Bitcoin futures, they didn't clear out the highs that we had at the end of November there, but we did get back above 90K. So we can't dismiss 6.9% on the session. What do you think about the liquidity in the market overall in terms of risk-seeking behavior? I want to think that today is a good session, but when I'm looking at the scoreboard here for sector performance, I only count 5 of the 25 that are in the green. It feels like outside of tech and semiconductors, which had decent days. Tech was up 1.02%, semis were up 1.807, right? Semis comfortably back above their April-September trend line now with today's close. Everything else feels like it was a bit of a, can't say I'm too impressed.
Well, I mean, this is really the story of this whole thing, if you kind of take a step back for a second. But for tech and AI, which is a singular sort of thing, you look at the equal weighted S&P or the equal weighted NASDAQ even, and it isn't looking all that great. It looks like we've been basically going nowhere since October. Well, let's call it early October for the S&P, mid-October for the NASDAQ. And in that sense, the sort of AI names, the 7 and just tech in general seems to be its own kind of sentiment barometer at this point. And I wonder to what extent it is almost like a bright light to the flock of retail money that's perpetually looking to buy the dip and is conditioned to do that now. Anytime that there is any kind of a dip, you get this sort of wave of speculative money that's never seen a down to turn, that's not necessarily prepared for the possibility that markets can also go down sometimes. That seems to be an almost kind of barometer unto itself. Risk on, risk off seems to have almost transitioned into tech on, tech off. So you see tech outperform today, but is that really a barometer for the broader sentiment about markets and really sort of the underpinnings of markets, the economy, the sort of financial architecture? Increasingly, it seems to be the answer is no. It's more like a barometer on retail investor sentiment than anything else. I mean, if you look at the professional investing, at least sort of chatter, everybody is exceedingly concerned. And everybody is kind of going, this is how speculative bubbles end. We don't know when, we don't know how, but this is looking hairy, increasing. And when you look at the price action, the skew in it kind of seems to validate that idea. Obviously, we don't have any great confirmation that this is the time to short the bejesus out of all the markets. But to your point, this does not portend strength the way that things are looking today.
We just want to square two things, like thinking about 2026 in terms of a North Star. You and I have had this discussion before here on air, thinking about, kind of the way that I approach markets is through a Mundell-Fleming model perspective.
Yes.
I care if fiscal policy is expanding or contracting. I care if monetary policy is expanding or contracting. I do want to note that we do see that Hassett's odds of being the next Fed chair took a dunk today, but that's because President Trump said he's going to make the announcement early next year. And so the no announcement by December 31st became the prevailing running favorite right now. But in terms of actual candidates, Hassett's at 15%, Waller's at 1%, everything else is under 1%. I think the market is convinced that if an announcement is made, it's going to be Hassett right now, Ilya. So I have that in one corner, and Hassett's probably the kind of guy who's going to push for looser monetary policy. Sure. Not like an apparatchik. He leans dovish, right? I think we'd probably get 2 or 3 rate cuts next year from May onwards. But he's also an economics professional, even though I don't necessarily agree with a lot of the outcomes that he puts forth or solutions to some of the problems.
Not unlike Stephen Mirren. I mean, Stephen Mirren is not a person who just blindly says things. He knows what he's talking about. I may not agree with his assessment, and neither does the majority of the Fed board, but he's not He's not a Peter Navarro. Yeah,
right?
He's nothing like a Peter Navarro. He's a competent economic thinker who understands how these things work. If anything, he's more like a Robert Lighthizer, who understands how the cake is baked. He's just not baking anything I would eat.
Right. So like with Mirren is credentialed going to Harvard and a trained economist. Peter Navarro cites Ron Vera, a fictional person that he constructed as a source in many of his books. So like there's a fundamental difference in terms of seriousness.
Yeah.
Of course, Peter Navarro has a great deal of influence over trade policy, which makes no sense to me. I digress. What I find interesting about all this is, so on one hand, you have Hassett's going to shift things in that direction, right? More dovish. On November 10th, the Trump White House put out a statement to Axios. There's no affordability crisis. That was in the wake of Mamdani winning in New York City. Today, he was asked, on affordability, are the American people getting impatient with the reforms you're making? Trump, I think they're getting fake news from guys like you. Affordability is a hoax.
Right.
So if
this
this
is going to be terrible next year if this is how this continues.
Well, I'm not thinking about the politics, right?
Mhm.
I'm thinking about the prognostication here. If I'm
Sure.
a fiscal authority and I'm saying that affordability, aka inflation, is a non-issue, that means that I'm geared to spending money.
Indeed.
I don't think inflation's an issue. So what's the problem with more deficits and debts? And as it turned out from the most recent government available data, which came out at the start of this month, we had a bigger government deficit in October of 2025 than we did in October of 2020 in the thick of all that COVID spending, Ilya. So here we have higher deficits than we've had before during crisis periods. We have a fiscal authority that's telling us that inflation's not a problem.
Yeah.
And you have now a Federal Reserve, a monetary authority that's going to be leaning a little bit more dovish. I don't know, man. Asset inflation still seems like it's on the menu for 2026.
I don't think there's anything unreasonable in that assessment. I think it'll be interesting to see how a asset Fed works, because we might be in an environment here where I can't really think of a historical analog off the top of my head at the moment, but it would certainly be the first time in immediate memory that you might have the Fed chair outvoted on some sort of a regular basis, because the Fed does have to vote. These policymakers do vote. And although they are not technically compelled to vote, at this point, everybody's expecting them to vote. Everybody's paying attention to dissents. It would be a tremendous blow to the Fed's credibility to change that system and somehow let Hassett run the place by decree rather than by consensus. So short of that, he's one guy. I mean, yeah, you can have someone like a Chris Waller for the past several months before the Fed started actually cutting in September, yelling into the wilderness and everybody going, oh, well, we recorded a dissent. Nobody else wanted to cut, so off we go. That might be Chair Hassett next year, if he is that. And so then you cue all of the frustration that the president would have with that, and it would take a long time to beef up enough
That's going to be
governors
attention.
on the board.
The market could get ahead of itself thinking that a Hassett Fed and all of Trump's picks are going to deliver uber dovish monetary policy. And when they don't, and they're a little bit more measured because of the constraints around the voting, it leads to a little bit of a letdown.
It's a different kind of a situation, yeah.
Yeah, Anna Wong, who's the head economist over at Bloomberg, she's been spot on with a lot of what's happening in terms of the Fed and the machinations around the Trump administration. So just as like a point of reference for me, I like to pay attention to people who seem to be accurate. Okay. And so that's going to change from time to time. Yeah, it changes from time to time. Some people have their ear to the ground in the right spots during certain cycles and certain, economic financial regimes. Others don't. And that changes over time. In my view, Anna Wong's has been a fairly prescient observer of the Trump admin and how it impacts monetary policy since the election. She writes that our view is that monetary policy under Hassett could see a slight dovish tilt. He has more faith than most current FOMC members in the potential disinflationary impact of productivity and deregulation, but not a wholesale shift. So I just think as a baseline, right, the Fed is going to keep easing. It's going to stay loose. The arrow right now is pointed towards easier monetary policy over time. And fiscal authorities are telling us that inflation is not a problem. So why do they need to stop spending the money? Why are the deficits an issue? That to me is like the entire thing of gold and silver. I saw a bunch of questions here today. Are gold and silver done rallying? I don't know if I personally...
It doesn't seem like it.
Silver is up at 59.21 right now, 59.20 here after hours. It finishes the day positive. Gold was off close to 2% earlier. Now it's not, back to 42.40. These are still probably my two favorite trades heading into next year.
I mean, I don't think there's any reason to get off the boat at this point. Certainly, there has been no evidence to want to get off the boat. Gold, yeah, okay, there's been a little bit of a pullback. There was a bit of a reaction high there, just under 4,300 there. That was the tops from early November. Not surprising, really, that there was a bit of a price response there. And if you look at the high, it pretty well lines up with where this market ran into it yesterday. So you look at all of this and you go, okay, so there was a bit of a price reaction to whatever that previous range top was. Where did we hold on the pullback today? In the former consolidation range preceding it. The trend higher is intact. So I'm fine staying long this. I'm fine staying long silver. I don't think any of the constituent parts of this, even when you take yourself away from kind of the U.S. government is going to spend a bunch of money and be really expansionary idea. Because frankly, if that were the case, if the market for gold needed for that to be the story, the dollar would be doing much worse. The situation in bonds would be meaningfully different. But they're not. So I don't actually think that
smoked at the start of the week.
They did, but that was really more about sort of everything resetting. So stocks kind of reset after the week they had last week, or at the very least, they pointedly lost momentum. Bonds reset a bit. Dollar changed gears. Ultimately, bonds are still in the same range they've been in for weeks. They just retested the bottom of it. But there's nothing going on here, and certainly that move in the bonds did not correspond with a surge in gold. Quite the opposite. And so you look at all of this and you go, you don't need expansionary U.S. fiscal policy to get gold moving higher. This is a bigger story. This is a story about deglobalization, about the trade war, about central banks wanting reserves in more diversified assets to be more nimble, and frankly, less sovereign dependent assets. Because again, we're going into a deglobalized world increasingly. If you're a central bank in this environment, you're not going to want to hoard one kind of sovereign asset or another. You're going to try to hoard something that isn't a sovereign asset because you trust nothing and no one increasingly. And that's just the nature of the beast.
Mm-hmm. Can I just get to something real quick here? I saw earlier today, someone in the chat was suggesting that they like trading Bitcoin. They're looking for the micro Bitcoin futures on the platform. If you do /MBT, those will pull up. There are also listed options, unfortunately, only for one expiry right now. And this is not a tasty trade thing. If you go to the CME website, you'll see that there's only one listed expiration for micro Bitcoin futures right now. But they are there. And if you are not seeing them on your platform, if this is something that you're trying to trade and you can't do it, just give a call into the trade desk. I've been specifically told if you reach out to Marty, he's the guy to help you. So Marty, sorry for all the extra work, but people want to trade micro Bitcoin futures. So let's make that happen.
And of course, there's also IBIT, which is the ETF version if you wanted to sort of manage your size and have a liquid options market.
Yeah, so I'm using IBIT. We put a position on last Wednesday. Tony and I, are you still short or are you long now?
So I took off half of my short yesterday. I'm still short the other half. So I still have a put vertical. I was in it for weeks. Yeah. So I rode down this entire move for the most part. I didn't sell the absolute top, of course, because you and I both like our technical confirmation, but
catching 20% of a 25% move lower is pretty good.
I'm not going to complain. So not at all. So I took half off yesterday because it looked like it had gotten to its former support. I still have the other half. I don't think that the bias has changed here. I think we're more like consolidated.
Yeah, I mean,
but I am doing it with iBit because it's liquid and the sizes are great and it's easy to move around in. It's actually a very kind of user-friendly instrument, iBit.
Yeah, and Bitcoin futures in the Z expiration December, the swing low here on this 4-hour time frame is the high that we have here on the 28th. It's roughly speaking 93,590. We'll call it, 93,600. If you punch above there, Ilya, I think that we have somewhat of a workable bottom to trade around. Looks a little bit, then would look like a little bit of an ascending triangle, so to speak, at a low, which could be a bottoming signal. Right? And then all of a sudden you go into the last few weeks of the year and you're thinking about, okay, if crypto's bottoming here and we got the rate cuts coming and, stimmy checks, this, that, okay, asset inflation's still on the menu. Maybe this thing has another squeeze to the upside, which I have some fun stats here. I know, everyone likes the little niche stats. Two of them coming from Ryan Detrick over at Carson Investment Research. Could December be strong? Any given year since 1980, when the markets had a greater than 10% return at the end of October, 20 such occurrences. For the last 2 months of the year, we have averaged a gain of 4.9%. Coming into December of this year, we had only moved up by 0.1% of the S&P 500. The average year, so any given year, the final 2 months produce a 3.3% gain on average. So you could say that when you're double digits by the end of October, there is a disposition for the final 2 months of the year to see kind of like a chase, in which those 2 months tend to be better than years in which the market's not up by, at least 10% by the end of October. The other one pertains to presidential years. Since 1950, Ilya, there have been 12 times since 1950, there have been 12 times that the S&P 500 has been up by more than 5% by the end of November at the end of year one of a president's term. On average, those 12 years produced a 2.1% average return for December with a 100% hit rate. As a baseline since 1950, the average December has produced a return of 1.4%, trading higher by 73.3% of the time. So, given my disposition, what's news to you? The stock market's up. It looks like it has a tailwind. We had all those seasonal things that were triggered and the SPY gap from the Thursday before Halloween. 68.70 goes in ESZ5. I got to 69.50 looks like it's going to be something the market's going to try to reach, at least test once more before the year's out.
I wonder what are these tailwinds of which you speak that we have not priced into this market already. And that is really the essence of what I think was the disappointment at the end of October. That there really wasn't anything else. The world was priced for perfection. And when the perfection was withheld because the Fed, and in particular Chair Powell's speech after that FOMC meeting, punctured one of the pillars of the perfection that everybody had priced in, everything deflated and has not reflated meaningfully since. We are still off that high. We can't even get back over the secondary high in the middle of November at this point. So I'm not sure that we have much of a tailwind assortment here. We'll see. But going into next week's Fed meeting, I suspect you don't get much in the way of follow through, because I think if that's what the markets are afraid of, and now we're at 89% chance of a cut again, and you can't get this thing to rally, looking a bit tenuous.
Heading into tomorrow, any significant changes position for you? I'm basically trading every single futures product right now, but I guess the goal here is long dollar, long stocks, sideways in energy, long metals, long bonds. Bonds obviously haven't worked out the past few days, but it feels like I don't see a reason to change. And if I'm also of the mindset that it looks like, if we wake up tomorrow with gold at 43.40, that would also not surprise me.
No big changes for me. I bought a little bit more dollar via dollar CAD or via selling the Canadian dollar. I did it through MCD futures, which are the micro futures. Still short a little bit of Bitcoin from the other half of my position. Short a little oil, long gold and silver. The only place where I'm short dollars is against the yen. That seems to be working. So I'm long dollars and long a little bit of yen. I added back into my EWZ position. I took half of it off yesterday and booked a nice little piece there. I'd been long from 27. And I peeled off half yesterday because it seemed to have hit the previous high, the swing top there from early November, and stopped. But because today it broke out, I added it back on. It obviously extended some duration. So that's really it.
There we go. Well, with that, overtime's out of time. We'll be back tomorrow, same time, same place, every Monday through Thursday, right after last call, 4 Eastern, 3 Central. So for Ilya Spivak, I've been Chris Vecchio. Good luck trading. We're going to stick around here, though. At least Ilya will be, because he's on next. Macro Money after the break.
The week continues to give us a sense of sentiment that has run out of juice. We get a little bit of a brighter view on Wall Street today, but not by much. So what is it that these markets are so jittery about, and why is last week's explosive momentum struggling to continue? That's what we're going to try to unpack here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And as ever, we are going to look at the price action here, take a look at where things might be headed, and from there, see if we can make sense of where this is insinuating we might go next. So let's begin here with just a quick rundown of where things went today. As we can see here, NASDAQ, the clear outperformer, and echoed there by a spirited jump from Bitcoin up almost 7%. But the broader markets are quite a bit more soggy. S&P 500 up a mere 0.2%, 10-year yield flat, 2-year yield just a touch higher, despite the fact that Fed rate cut odds actually firm up today. If we take a look at where we are on the CME FedWatch tool here, looking at Fed funds futures and extracting from them what the markets are pricing in, we're just a touch north of 89% chance that the Fed is going to give us a 25 basis point rate cut next week. That's the highest we'd been in at least a week. So there's a week ago here. Of course, the most interesting bit here is that while the markets were very strong indeed last week, just remind ourselves, here's last week's performance, strong gains for stocks, a strong gain for gold and for Bitcoin, a weaker broadly US dollar. We can see that the euro up here is a little higher. Yen is flat, and that's something of a victory for it after all of the precipitous falling that the yen was doing leading into last week. And yields are off for a second consecutive week. So there was a real sense last week that the markets were cheering that the rate cut was back on. Because indeed, as we can see, a month earlier, that was not so much the case, or at least not with the same kind of conviction. And of course, for the longest time there from the Fed's meeting on October the 29th, we were in 50-50 mode. And for a while there, the odds were even favoring with better than even odds that there will not be a cut. So by the beginning of last week, the markets were already well over 80% in the there will be a cut column. And so we get this extension here today, but it's not like that rally last week was predicated on something the markets ostensibly didn't know. It was already priced in by the time last week kicked off, with a likelihood so convincing that it seems like last week's move was more about sentiment readjusting after an elongated risk-off period and ahead of a holiday week where liquidity was going to thin out and market participation was going to decline, rather than anything novel that occurred on this front. And indeed, again, today, this soggy showing is occurring despite the fact that those rate cut odds have only strengthened. So looking at this today, it seems as though what we have is, again, some residual sentiment hesitation to follow through. Now, as far as the data flow or news flow is concerned, there wasn't all that much today. The Eurozone published their inflation data. It came out a touch hotter than expected, 2.2% year on year for November versus 2.1 expected. But there's really not a whole lot for the markets to be doing, as it were, with that information. And indeed, we can see by the euro's performance, it didn't really go anywhere. And that's because if we look at policy expectations as they are priced into the European interest rate futures complex, these are ESTR futures, the Eurozone equivalent of Fed funds, there's nothing on the menu here as far as policy adjustments, of course, for the rest of this year, but also next. Here's the priced-in outlook for 2026.